That's the obsession of the markets as rates set to come down, of course, further and further. The US Consumer Bank missing expectations. The CEO saying that the lender is on track for some of its cost-saving targets. Guy?
Some of the parts story then this morning, we need to factor those single stock stories into the wider index. Let's do that now. Thursday session is almost upon us. Let's give you the opening trade, give you an idea of what is going on here. We are anticipating a positive start. There's also the legacy story coming out of the States yesterday, plus fold in a little bit of Tesla positivity, and you get this. The FTSE 100 that is up a little bit, not by much, but we're in the green. We'll see whether we climb from here. We'll see what other markets do. The FTSE 100 doesn't. Actually, it does now climb from here a little bit, up by, as you can see, 0.2%. Stock 600's absolutely flat right now in terms of where we are seeing the market, but we'll wait for the CAC to open. We'll wait for the DAX to open. There's some really key stocks that we need to watch out for. Hermes, Kering, Siemens, some significant names that are reporting or delivering news this morning. The IBEX is a little flat this morning. Not much action there. Kriti, give us some of the single stock sector stories as well.
Well, I'll start with the positivity just because we're opening in the green here. A lot of it actually coming from two major names, Unilever and Barclays showing up in the FTSE 100. Unilever also pushing up the stock 600 as well. So those are the two names to really keep an eye on that Anna had highlighted previously. Hermes seems to be well, we're waiting for the opening trade on that for a little bit more volume there. But Unilever seems to be I think the game changer in the move at the moment.
Yeah, in terms of the sector breakdown, then you've got personal consumer goods, grocery stores. That sector, that's the best performing, and so Unilever up by 2.25% as a result of that. Yeah. We also had those numbers out from Danone, and as you say, keeping an eye on what's going on the luxury space. And Hermes does seem to be up by 3.1% this morning. A very different story to Kering. Kering in focus because, of course, we heard from them last night, dropping their full-year guidance to the lowest since 2016.
Renault is the outperformer, though, on the CAC Quarante this morning, just up a little bit more than Hermes this morning. It is up by nearly 3%. Apparently the new Renault 5, which was the coolest car when I was growing up, is delivering quite nicely, the electric version of that. Danone is up, Orange is up, Bouygues is up, so the telecom sector is also having a good morning. Some of the commodity stocks as well, Total rising on the French market, which is actually now beginning to soften up a little bit, which is interesting too. So the downside is where maybe the weight is, but that seems strange given the fact that we've got 27 stocks up and 11 stocks only down. But you've got Dassault, Sanofi, Carrefour, Accor, Saint-Gobain all trailing this morning. Airbus is a little bit softer, but not by much.
But you know what's strange there is that Kering isn't one of the underperformers this morning, and you would think that it would be, just given the pain that it really highlighted in Gucci. Instead, it feels like Hermes might be lifting the stock up in respect. So that's
there's also a lot of bad. There's an anticipation that there's a lot of bad news
at Kering
that we've already priced in and factored in. So is this new news? Is it really a shock that it's going to take longer to turn Gucci around? I think to many people's minds, probably not.
Yeah, it's certainly one to keep a very, very close eye on. A lot of kind of moving pieces as well. And of course, we are still waiting for some of the other indexes to open as well. A little bit of a mixed picture, sum of all parts. Let's take a broader view here. We're joined now by Ann Doe, portfolio manager over at Julius Baer, joining us around the table. Good morning. I think we're all trying to figure out right now what is driving the European markets. Is it still a ASML, a Novo Nordisk, as what Guy would call the sensational six, the core six, that is the granolas, if you will, that are driving the upside the way that it is in the States? Or is there more to it? Is there a fundamental bull case for Europe?
Yeah, good morning. In Europe, market concentration, it's a topic of debate, and Europe is not alone in that regards, right? The US market is also pretty concentrated. That said, at the moment, you still have a preference for the US market. We think that Europe, even though the valuation discount is there, these stocks are cheap for a reason. If you look at the sectoral composition, it's quite different compared to global counterparts. Europe is also quite exposed to some of the macroeconomic headwinds we're seeing. For example, the story so far in the luxury sector is about the Chinese consumer. Year to date, we're seeing a lot of news flow around Chinese consumer, Chinese policymakers, what they will do and not do. We think so far policymakers have not done enough with regards to policy stimulus, at least in relation to the long secular downtrend in the property market, which is really a balance sheet recession for the Chinese consumers.
Yeah.
So Europe, I think, is quite exposed to those kind of trends, which we don't see getting better anytime soon.
Give us a sector-by-sector breakdown, though. Where are you seeing, perhaps, the most volatility? You pick the direction.
In Europe, the earnings season has given us some clue as to the volatility in the subsectors, right? So far, we're seeing the most exposed area in the consumer discretionary sector. You have auto companies really seeing headwinds from Chinese consumers, but also from the global general trends in weakness in consumers. In luxury sectors, we've seen a lot of growth damage coming from just a change in the Chinese consumer consumption patterns. They've gone through 2 years of property prices decline, and maybe perhaps that they've now just started to change that consumer consumption patterns because of that lack of confidence in the economy and where it's heading over there.
What's your degree of certainty at the moment? There seems to be a lot of uncertain factors that we have to deal with. If you are going to be risk on at the moment, how convinced can you be by that, and what kind of a portfolio do you need right now to manage some of the risks surrounding that uncertainty?
It's been an uncertain backdrop for the macroeconomic environment. If you remember in the summer, there were a lot of fears around a US recession.
Yep.
Now we're heading closer to election. So it's an uncertain backdrop. In portfolios, we are neutral equities. We continue to like high-quality stocks. We have taken that, actively managing that over the summer.
Yep.
In the summer, coming into middle of this year, we've taken off some risk, but then in the middle of the carriage itself, we've added to risk, given the view that the long-term bull trend is intact.
Yep.
But that said, we barbell that with still a high position in cash, making sure that we have enough firepower to take advantage of any dislocation by year-end. We've also added gold to multi-asset portfolios in May, and it's been a good hedge so far.
Okay, you're going to continue to add to gold? Do you like these prices as they are at the moment? Record after record.
Gold continues to exceed expectation.
Yep.
They continue to decouple from what people see as traditional drivers in terms of yields, in terms of inflation. That said, we think this is a really long-term trend for gold. We've added to a neutral position, 3% in portfolios in London, and we think we'll assess it from here to year-end.
Okay. Can I ask you about something you just said there about the long-term bull trend is intact, and AI stands out in your notes as something that you're leaning into, like many investors, I'm sure. Where do you see the best opportunities to lean into AI now?
AI is definitely a core thesis of the long-term bull thesis that we have. Clearly, the stock market in the US in particular has benefited from AI, something that Europe perhaps lags behind. In terms of stock specifics, AI winners, if you take a step back, the long-term winners of the previous technology adoption cycle can really emerge at the latest stage. If you think about the internet cycle, the biggest beneficiaries in software and social media didn't really exist even 10 or 15 years after the internet really came to be.
Yeah, it wasn't about the people who put in place all the Wi-Fi connections.
The infrastructure,
and the
right?
infrastructure, yeah.
Exactly. So we see it in a few stages. At this point, the infrastructure is still important. So we still like semiconductor plays within AI. Those key component providers will remain key. But we are open-minded as to the next few phases. For example, in software stocks have lagged semiconductor stocks by a lot year to date. But as the AI cycles continue, as software companies are where the monetization of AI is, we continue to like exposure there as well. So there's a lot to be said about continue to keep an overweight in technology because that trend can broaden out.
We've talked a little bit, and you've mentioned in passing Europe's reliance on Chinese consumers, and that's a story we've revisited time and time again over recent months, it seems. Is this still a cyclical story, or is there something more structural happening here? Changing tastes in the market, a changing focus for the consumer, what they want to spend their money on? I mean, what is happening in the sort of the Chinese consumer space? Because it does have such an impact on these European luxury names in particular.
Absolutely. In the midst of this cycle, it's difficult to disentangle what is structural and what is cyclical. I think there are both elements. The structural story is that the Chinese economy is going through a balance sheet recession. It's our view that we don't think policymakers have done enough to address the deleveraging issues as well as demographic issues for which there isn't an easy cure. So there is that structural element that we think will stay. The cyclical element is of course, tied into policymakers' their increased appetite to stimulate the economy, but we don't think they've quite done enough.
Because a lot of these consumer companies, they say it's hard to assess the stimulus and whether it's going to make much difference. We heard that from Kerry.
Absolutely.
And walk us through the sensitivity, or maybe lack thereof, between the stock market and the bond market. And I add this in the context of simply a major bond move that we're seeing this morning in UK gilts, the 10-year higher by about 5 basis points in terms of that yield. How should we be thinking about what's happening in the bond market in terms of the effect on the stock market?
Absolutely. In terms of the bond markets, I think the Fed really set the tones, and therefore, more recently, I think the fact that the election is on the horizon really comes into the picture. With all the talks of fiscal deficit, you're seeing 10-year bond yields in the U.S. up higher by close to 50 basis points in the last month or so. So the U.S. set the tone, and the gilt market doesn't exist in isolation. When do equities start to pay attention? I think it's regard to how fast bond yields can rise, right? So far, 1 month at that pace, it's been pretty gradual rise. But that said, we're on the watch for the reason why bond yields are going up. Because if bond yields are going up because the economic growth is doing well, because the U.S. economy, unemployment remains quite controlled, inflation is controlled, then there's still reason for equity markets to continue to outperform, given the core driver being economic growth. We'll continue to see the volatility in bond markets and the speed at which bond yields can come up.
Is there anything the market's missing at the moment? Like it's interesting to see what's happening in commodities, which actually, in some ways, apart from gold, actually look like they haven't had a great run. Well, they haven't had a great run. Do they look mispriced right now? Is there a space on the curve that looks mispriced? Where do you see the dislocations right now? Are there any anomalies that kind of stand out that you're looking at, trying to examine? As you discuss this around the table, you're saying, actually, maybe there are areas in which the market is getting it wrong, or is the market always right?
Interesting question. In terms of market expectations, which is the core of your questions,
Yep.
I think coming into this earnings season, we're seeing a revision down in terms of expectations of earnings growth. That said, there is a broadening of this earnings growth, right? In the next year, you're seeing the driver of earnings growth not being so concentrated anymore. We are cautious about that view. We think that the economy in the U.S. has continued to grow this year. Will it continue to deliver the same pace next year to deliver that broadening of earnings growth?
Yep.
We're not too sure. So at the moment, we still favor the long-term secular story in our stock selection because there is more confidence to that longer-term view as opposed to a more cyclical-driven earnings revisions for the broader market.
Okay. And that from Julius Baer. Thank you very much indeed. Still trying to figure out what's going on in gilts. Anybody got any answers? Please let us know. Always interested. The Core 6 looks a little bit like this morning. This is the picture that we are looking at, a broadly positive picture, as you can see, pretty much across the board. It's not been often these days that we've seen every single one of these single stocks actually moving in the same direction, i.e. higher or lower. Today, we definitely get the higher story. Let's find out what else we're watching this morning. Joe Easton, over to you.
So we are actually seeing positivity in the luxury sector, as you guys were mentioning just a moment ago. So Hermes getting that 11% sales jump overnight in terms of their quarterly earnings on the Birkin bags that they can't sell enough of. But Kering actually gaining as well, up 2%. Now, bear in mind, that stock is down around 45% on a year-to-date basis. And traders saying exactly that. This is really just bad news already priced into the stock. So really no further losses to come at the moment for that one. Both of those stocks firmly in the green at the moment. Then another stock doing well in France is Renault, bucking the trend of a slowdown in car sales in Europe. The R5 model, as Guy was mentioning earlier, doing really well. So that actually a bit of a boost for Renault this morning, up almost 5%, outperforming really today. Then in terms of Unilever, Anna mentioned earlier that stock fell yesterday. This was after some Asian units, the India and Indonesia businesses reported sales early. It hit the stock, and we're basically just recovering all of that today as the Ben & Jerry's ice cream maker reports pretty strong sales for that one this morning. Barclays edging up following those better than expected UK net interest income numbers, and also going the other way down in the car space, autos in tyres as Michelin, we mentioned earlier, really weak numbers out of them last night. And HSBC coming early, already downgrading the stock, no longer recommending buying following the downturn there. Carrefour, meanwhile, Over in groceries, that actually looked weak in the US trading in their ADR, but actually holding up pretty strong at the moment in terms of that one. Then we also had Danone, Activia, water and yogurts. That's the company over in France as well. Now that one gaining pretty strong numbers. That is a pretty strong and steady company in terms of their sales, a bit of a defensive one. Activia yogurts that we all love, that one gaining at the moment. In terms of some other news away from earnings, we've had quite enough earnings today. Siemens, we mentioned that deal around $9 billion, according to a Bloomberg exclusive for a company called Altair in the US. We'll wait for confirmation of that one, but the stock edging very slightly lower. Eni over in Italy, selling a big stake in their Enlive decarbonisation platform to KKR, according to breaking news on that one. And Mike Ashley is back at it again in the UK retail space, trying to get the CEO position at Boohoo, according to a statement that broke on the terminal at 7 a.m. He's looking to muscle his way in there in terms of the UK retail magnate. Finally, just one morning call. This one really stood out to me. Shell. It's a neutral over at Citi, but they've opened a 30-day catalyst watch because there's a big court case coming up next month around their carbon levels in The Hague in Amsterdam, and Citi reckons that will be favourable. They think you should be buying into that court ruling. So that one edging very slightly higher for Shell in London this morning.
Joe, thank you. Joe Easton with an update on some of those corporates that are in focus this morning on the back of a host of earnings stories. So we continue to make pretty decent gains actually across European equity markets, up by 0.5% on the stock 600. We are getting numbers from the French economy. We're getting PMI data coming through. The manufacturing PMI dropping below estimates, so continuing to be weak there, 44.5. And the services number also coming in below estimates and continues to be below 50. So unlike Germany, all of these numbers are in negative territory again, have been, were previously, and continue to be in not negative, sorry, below 50 in contraction territory. So I suppose, we've made that leap already, but these numbers coming in lower than expected, and we are seeing some weakness in the euro on the back of that.
Yes, we definitely are. 107 handle is where we started the day. It looks like it's slightly bounced back. You're not pairing that initial kind of knee-jerk reaction that you saw. The bond market, to me, is what's getting interesting, though, because you are seeing, of course, movement off of this data set in all of the European yields. We should talk for a moment about what's going on in this gilt market as well. About a 5 basis point move to the upside on the 10-year. Some folks pinning this to the comments of Andrew Bailey in the last 24 hours. Others saying that this is just a positioning story. When you look at cable, we're still at 129. The move isn't as high in the currency market as it is in the bond market.
Yeah, it seems to be mostly a bond market story, doesn't it? And he did say last night that the disinflation trend is happening faster than expected. You might have expected that to mean yields go lower. Was it about the nuance? Was it about some of the lines he said about services inflation?
Is it about him at all, or is it just the budget's coming?
Maybe it's that. We are only days away. Next week.
Absolutely. France remains trapped in an economic decline as the fourth quarter begins, with challenges from the third quarter persisting. Those are the comments surrounding the PMI data out of France that come with the data this morning from an economist at Hamburg Commercial Bank that is listed here on the press release. The numbers really don't look good. France's private sector economy registered a further deterioration in October. Business activity shrank at its quickest pace since January. The numbers, again, out of France look pretty ugly.
And we have seen that the two-year curves in Europe are certainly responding to this. We put up the data on the 10-year and showed that there was a little bit of response there. But we see the two-year horizon really responding. So 7 basis point moves in France, in Germany, and Italy, also not down quite so much in terms of yield, but down a little. Coming up on the programme, we'll get back to some of the other corporate stories. Talking of France, Hermès gaining this morning as the Birkin bag maker shows resilience amid a wider luxury slump. We'll get a deep dive on those results next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It was going to keep Green World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Minutes into the equity session, this is what we look like this morning. A broadly positive picture. As you can see, we're up by, let's call it, circa 0.5% across Europe. The luxury sector is actually doing all right this morning. Even Kering's having a fairly good morning. But the story, the standout story, continues to be Hermès. Its shares in the green this morning. The company reporting a rise in sales. It says here retailer. I'm not sure we can really classify Hermès as a retailer. Pricey handbags. Nice things, basically. Broad luxury doing reasonably well at the moment, but Hermès continues to outperform. Chloe Mele joining us now around the table to talk about this. Is it just different? Is this company just different to everybody else?
Well, it seems like it is. It does seem like that. So it's yet another good, resilient quarter, another quarter of outperformance for Hermès. I think it is still worth noting that in terms of quarterly revenue growth at constant currency, it's a little bit weaker than previous quarters, but we're still talking about double digits, which is something that some of its peers would only really dream of. And so it is bucking the trend. It does seem that way. There's still a little bit of weakness in China. So sales in Europe, the Americas, Japan, that all exceeded estimates. But if we look at the region, including China, that came in below estimates. So the fact that the consumer confidence in China is kind of reaching pandemic lows, it does still have an impact on Hermès, even though it keeps that kind of edge over its peers regardless.
But it feels like so much of the edge is really just coming down to the Birkin bag. And we've been talking about this for years now in terms of what's going to make a dent into the wealthiest echelon of consumer. Do we have any clues on that?
Well, Hermès, the reason why it's been really able to withstand that pressure is, as you said, is because it's just so high end. You know, that means that it comes with a kind of a loyal customer base. It comes with an exclusive price point. You know, if you can afford a Birkin bag, you can afford it regardless of the circumstances, regardless of the economic slowdown. I think in terms of, and you can see that as well in terms of the segments in Hermès, so the textiles, silk and textiles, that's a bit more of an aspirational segment, and that's also kind of a weaker division. So it's a story that we've seen over the last few quarters that still continues this quarter, where, you know, the resilience comes with being really high end, and it's going to be a bit more difficult for the companies that are a bit more aspirational, and we can see that with Gucci also.
Chloe, yes, we did in the Kering numbers. Thanks for the update. Bloomberg's Chloe Mellet with the latest on Hermes and the luxury sector. Let's turn to another earnings story this morning. Barclays shares higher after delivering a profit beat. The CEO has just been speaking moments ago, saying the UK and the US are on track for a, quote, feather soft landing. That's a nice line. Let's bring in Bloomberg Intelligence senior banks analyst Philip Richards. Philip, good morning. So clearly Barclays will be hoping to make the most of that feather soft landing, if that's what we get. What have been the key drivers then? We saw an 18% rise in profits in the third quarter. What are the key drivers?
Yeah, hi. It's been across the board beat, I'd say, overall. Revenues are slightly better, costs are slightly lower than expected, obviously a positive, and loan loss charges also coming through lower. And it's been the UK bank which has really been the driver so far. And elsewhere it's pretty much in line. So yes, it's positive, but I wouldn't say it's outstanding. It's not a blowout sort of numbers.
NII guidance is up. Where's that coming from?
Well, it's coming from basically the margin holding up firmer than expected, and also volumes have been picking up in terms of those rates starting to come down. But that guidance was only for this year, 2024, and that's pretty much in the bag already. Consensus was already there. What we all care about is what about next year, about 25.
Absolutely.
And the bank were very quiet on that.
Right, and so on that NII story, it's interesting, isn't it? Because it's a bit like the US, where NII held up better than expected for certain banks. But also going into these numbers, I was reading that many analysts say that Barclays, actually I think they said it about Lloyds as well, has a structural hedge to the declining rates environment. So is this about Barclays specifically, or is this about UK banks?
It's UK banks, and that structural hedge will support them all in terms of their low impact on the NII, but also 2, 3, 4 years forward, can they maintain that revenue momentum? That's what's key for them. And Barclays have these big 2026 targets, and consensus is somewhat below those levels. So yes, this year's in the bag. First half next year is fine, but what about the second half next year into 26? Can they sustain that?
One of the standouts of the U.S., though, when that kind of hedge against the net interest income that Anna was talking about, was the fact that investment banking and some of the deal activity was surprising to the upside. Is Barclays getting in on any of that?
They are. They do see themselves as, the European competitors, the big US players.
Yeah.
The US is a big bulge bracket, but corporates still want to have a European angle on that side. And actually done very well on that. Their fee income's up very strongly. They've beaten estimates on fixed income, on equities as well. So yes, overall pretty strong on that front.
It's a fascinating one as we talk about the capital markets activity and kind of coming back, maybe deploying some of a lot of those funds that are caught up in the PE space. Philip Richards over at Bloomberg Intelligence, we thank you so much for giving us that insight. Of course, as we're speaking, the bond market is going wild, for lack of a better term, whereas the currency market feels a little subtle. I mean, we're looking at a currency market of 107.71, on euro dollar, 129.47 on cable, to match, by the way, 5-6 basis point moves in the European curves.
So you got the PMI data out of France this morning, which looked super weak. The commentary coming out of market on the back of it is really, really bad. First time we've seen the service sector and the manufacturing sector deliver job cuts in the 4 years. We're talking about confidence within the manufacturing sector back down to 2020 levels. These are really grim readings, and it's understandable maybe therefore why the market is pricing in the front end, maybe to deliver a few more cuts from the ECB.
Yes, so traders now favouring a half-point ECB interest rate cut in December. We see that reflected. The 2-year, we do see a lot of movement. Christy, as you've been saying, those yields really coming down, 6 basis points on some of them at the short end. In the UK story, things look a little different, as we've been mentioning. I wonder if there's a bit of rotation there, a reassessment of just what kind of rate cuts we're going to get from the ECB versus the Bank of England. We're going to get some more data, though, on Germany, aren't we? Just coming on the other side of this break. We're going to get data there. Will we see services below 50? The expectation is we don't, but if we did, then all measures on the German economy would be below 50. We'll certainly focus in on that. We'll also have a conversation about family offices. They're pouring their money into risk assets. We'll talk through their performance. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their Their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is the opening trade. We're about 30 minutes into today's session. Seeing green on the screen when it comes to the European stock market. And this is some broad gains despite some of the mixed earnings stories that we've got across the continent. We are also seeing German PMIs break across the term right now. The services PMI rising to 51.4. The forecast there was 50.6. Manufacturing PMIs coming in better than expected, but still below 50 in that contraction territory. 42.6 there. The estimate was 40.8. This is, of course, coming on the heels of that French PMI data that we got, which suggested the exact opposite of what we're seeing in Germany.
Right, so the euro being whipsawed, we're also seeing a little bit of movement in bond yields. So bond yields across the Eurozone had been dropping today. That was reinforced by what we saw on the French data. We're seeing a little bit of a pairing of that yield drop just now on the back of the German data, which doesn't necessarily, didn't move in the same direction. But we're still talking about a lot of weakness in some areas of the market. Although, is this manufacturing? I mean, bouncing along the bottom is the phrase we've used for just so long to talk about the Eurozone manufacturing story. It's still not in expansion territory, still contracting, 42.6. It is better than the estimate of 40.8. But that's the only green I can.
Bouncing along the bottom probably is maybe the way of looking at it, but certainly better than anticipated. Certainly seems to be the story. In terms of kind of where we're seeing that, the service side is obviously interesting. Manufacturing does continue to be an area of concern. The dearth of incoming new work was reflected in a further sharp increase in outstanding business in October. Firms, therefore, are looking to reduce staffing capacity, resulting in a fifth straight monthly decline in employment. So there is still quite a lot of negativity embedded within this. It's just slightly better. Kind of things are pretty grim in Germany, and there is obviously maybe a little bit of positivity coming out of this, but I think it's fairly scant.
I think there's also a point to be made here, and the market reaction. Anna mentioned the two-year story as well. You're seeing a little bit of spread widening, slight spread widening between the French and German debt, though the rest of the periphery, those spreads actually closing in. So we'll see how that all shakes out in about 30 minutes' time, Guy.
Yep, firms forecasting activity to rise in the coming year.
Deep into the PMI statement.
I am. I'm just. This is good stuff. We'll move on in just a minute. It is interesting to see where this is coming from in terms of the fact the firms in Germany are talking about a potential pickup. Let's talk about what else is going on. How do you manage all this? The world is a super confusing place right now. You've only got to look at compare and contrast the French and the German data this morning. So how do you deal with all that, and how do you factor that into a portfolio? Well, the world's wealthiest individuals and their families have significantly upped their portfolio's exposure to equities this year. This according to a recent survey from Citi Private Bank. The Family Office report shows more than 40% increased equity allocations, with the strongest pivot in Asia. More than a third cut their cash holdings. We're joined now by Hannes Hoffmann, head of the Family Office Group at Citi Private Bank. Morning.
Good morning. How are you?
Nice to see you. Look, the world's a really confusing place right now. If I look at the read I've just read, and the data you're giving us, it would seem to signal that we are very risk-on in the family office space. Is that a true reflection of what we're seeing?
Well, look, so the first thing, thank you for having me here, Guy. The first thing is we did the survey now the 6th year in a row. So we've got a history of looking at data of the biggest family offices around the world. There's a few things that stood out for us. The first thing that stands out is we've seen a lot more family offices participate than in any year before. So we used to have somewhere between 80 and 150 participants. This year we had 340, which makes this the biggest survey in the industry. 340 means we've got a really good insight into what families are doing around the world and very good quantitative and qualitative data that we can use. So what we've seen in the survey with so many family offices participating is that definitely there's risk on sentiment, right? So family offices have gone into it last year with a lot of worry about inflation and where would rates go and would we go into a recession. This year, the sentiment is completely different. We've seen people take money out of cash, like you've said, move into fixed income, into private equity, into public equity, and they're doing this with a very positive outlook for next year. So what's interesting, in the last 12 months, we're seeing positive returns for about 80% of family offices. So they're coming from positive experience and positive expectations of 97%. So what's interesting, 97% of family offices we've interviewed are expecting positive returns next 12 months, which is the highest number in the last 6 years. So is the sentiment bullish? Absolutely. We've seen that in asset reallocation, but we've also seen that in the performance expectation that these folks have coming from a strong past 12-month period.
But they're buying bonds, so there's some hedging going on here. Is that what that is? That is for? Like, how do they hedge that risk? I'm presumably this is a multi-generational process that unfolds here. It's about wealth preservation as much as capital increase. How are they making sure that the wealth is preserved and can grow in the future?
Well, look, I would say the most important thing here is they're looking at asset allocation as their number one tool to achieve their investment returns. From an asset allocation perspective, there's different asset classes to invest into. So you're saying they buy bonds. They did move cash from cash into bonds, so into longer dated fixed income. But the biggest moves really have been in the equity space if you look at private equity and public equity together. Let me give you an example. 77% of family offices invest into direct investments. Of those that invest into direct investments, more than 50% have increased or significantly increased their direct investment activity. That's investments into companies in Series A, B, C, D, typically earlier than pre-IPO, but not as early as we see. So we see and pre-IPO are kind of like smaller allocations, but the ABCD, the classic investing into companies with a proven business model, that is something that a lot of them do. So it's not about buying bonds, it's about reallocating out of cash into other areas that generate better returns, including direct investments, private equity, public equity, and fixed income.
And Hannah, so help me join the dots here then between what we're seeing at the sort of geopolitical level and what family offices are doing. Are family offices concerned about politics? Do you see them trying to protect themselves from what might happen or even just volatility around the US election? Is this something that they're very preoccupied by? Or are they just, they just think it doesn't matter to their portfolios, they're protected, it's just short-term impact? What's the view there?
Well, so Anna, it's very interesting that you asked the question. I think when we look at one of the questions we ask in the survey is what are the main risks you're concerned about? And in previous years, inflation was usually the number one risk. Not surprisingly, we're now in an environment where a lot of the family offices are saying inflation is not that important anymore. So it's dropped to like number 4 of risks. The number 1 risk is the interest rate circle. Geopolitical uncertainty is also up there. What's interesting, just for people who actually see the survey says that the Middle East is only the number 6 risk, so fairly low down. But I think that has to do with the timing, because that was taken in June of this year. And as we know, over the last few weeks and months, the situation there has increased. So they're very risk aware. They're very focused on what the opportunities and risks are, especially now with the US election. Obviously very binary in terms of the policies that will be implemented. People are positioning for that. We're seeing that in some of the key data. For example, 70% of family offices have concentrated stock positions. Of those that have concentrated stock positions, a third are looking at doing something with them, and the majority using derivatives. That indicates to us that what you see is a lot of interest in how do you use low volatility in markets to potentially position, protect concentrated positions, potentially like exit them with enhanced yields. And we're seeing a lot of requests for this kind of activity to coming in.
You mentioned earlier about this move from cash to long duration fixed income. The biggest risk in that part of the curve is the deficit. How do you price in the deficit for a long-term investor?
Yeah. So what's interesting about the deficit is people are definitely concerned about that. Two ways to look at this. One, you have to weigh the risk of the deficit with the short-term path of interest rates, right? And as you know, when the Fed started like its easing cycle at about 5.5%, people expected, market expected, rates to go down to well below 3. I think most family offices thought that was too aggressive, but they still thought that there was a trade-off along the curve. When it comes to the deficit, people do try to invest into that through credit and through equity investments.
Yeah.
And another topic that we should briefly touch upon that we're seeing a lot of family offices talk about is global asset security and global mobility. So where, from a location strategy, should people go that deficits might be increasing and tax rates might be increasing? People are aware that now corporate profits are 12% of GDP. 40 years ago, it was 6% of GDP. So.
Okay, yes, but that part of the curve was also responsible for this kind of bond crash, basically, in 2023 as well. Can you still look at it as a hedge, though? Or is this kind of still a scary part of the market, I guess is my question.
You mean the fixed income?
Yes.
Look, I mean, again, it's all about portfolio construction and how you combine a portfolio of treasuries, of...
Well, how are you combining it?
Well, we're definitely recommending that clients invest into fixed income securities as part of their portfolios. Here's one thing that's interesting. What differentiates family offices from other investors is that they can take a really long-term point of view. And so what we're finding is family office portfolios resemble university endowments a lot more than other institutional investors' portfolios. So we're seeing about a 40% allocation to alternatives, which is much, much higher than what we see most investors do. And that 40% allocation to alternatives works very well when you take a multi-generational view. And so generally, their fixed income allocations are less than other investors with a bigger emphasis on long-term investing. And that should provide to many of them some sort of a hedge, if you want.
Hannes, nice to see you. Thanks for stopping by to see us and bring us the report. Hannes Hoffman from Citi Private Bank. Thank you very much indeed. Bit of breaking news while we've been having this conversation. The European Union's top court sided with Intel in a case that centres on abuse of market power. Intel's having fairly mixed news at the moment. Here's a piece of good news. So winning that fight, this is an antitrust case that has been going on for quite some time, Kriti. Generally, actually, it's been fascinating to watch how some of these technology companies have fared in both cases in the United States and here in Europe recently. Obviously, we watched what happened with Ireland. It's now interesting to see that the European Union may be having another setback when it comes to Intel.
Yeah, not a surprise here that the courts have been aligning the courts have been aligning with the companies themselves.
Yeah.
This is also a big question as well in terms of the amount of fines, because even the fines that were on the docket were something like 400 million euros among one of the fines among others. It's not a very big number in the context of what Intel has to deal with. So, of course, that is the tech story that we're going to be keeping an eye on in terms of the ripple effects to other places. In the meantime, let's talk about another thing going on in another part of the world. That is NVIDIA CEO Jensen Huang has just been taking part in a fireside chat with Mukesh Ambani, of course, one of the major billionaires, the richest person in India, and arguably one of the biggest in the world, on the future of AI in India. Take a listen to what he had to say about technology in the country.
In order to lead in artificial intelligence, you need to have AI model technology that India has. You need to have data, massive quantities of data. And using the last thing you need is AI infrastructure. And we're announcing that Reliance and NVIDIA are partnering to build AI infrastructure here in India.
So Jensen Huang talking about that partnership with Mukesh Ambani, and I think the context for an international audience is really important here. Mukesh Ambani is the chairman of Reliance Industries. It's the biggest conglomerate in India, and one of the key projects he's taken on there has been bringing internet and kind of the telecom sector to the masses through this major project called Jio, which is Hindi for life. It basically is this underlying story that you basically have to get over 1 billion people online and on the grid. How do you do that? With NVIDIA chips.
Right, and then this is creating then some of the excitement we talked about at the beginning of the week around investment in India for the access to that large population and what it might do, but also because it has a great place to test what you can do with consumer-facing technology products. So I spoke to Process earlier in the week, and that was the point they were making about how excited they were about things they were doing, consumer-facing technology products in India.
It's going to be interesting to see what does this all mean for the Indian stock market, which has had an absolute tear of a run recently.
Yeah.
And I'm just wondering whether that's actually beginning to conclude, whether all the good news is already priced into this as a market and it's going to struggle to make headway from here. You then factor in also the fact that people are going to be maybe moving money out of India and putting it back to work in China. Just from a market point of view, have we seen all the good news from India?
So India is really tricky here in terms of these partnerships, especially when they partner with critically important companies like NVIDIA to the world, because historically they're very careful about who they partner with and who can actually access the Indian subcontinent. So the fact that they're opening their doors to NVIDIA is important. I'm curious though what kind of tailwind it does for pricing. If you suddenly have this much demand from one of the biggest and most populated countries in the world, can NVIDIA match all that capacity? I don't know.
We will continue to watch that story. Coming up on the programme, we've had the data out of France. French services PMI comes in lower than expected, but some reprieve then, perhaps from Germany, with the manufacturing print there coming in slightly better than expected. The services number did not drop below 50. We'll discuss all of that, the slightly mixed signals, the slightly better news coming out of Germany. We'll talk about what it means for the ECB. That's next. This is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
DOJ or other
authorities.
Could face bigger challenges.
Britain's election
was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. 8:48 here in London, 9:48 if you are in Paris or Berlin and digesting the latest data coming through from the French and the German economies. Now, traders have upped their bets on a half-point ECB rate cut in December. This after the French services PMI came in lower than expected. But then that was followed in Germany by perhaps some reprieve, with the manufacturing print coming in slightly above expectations, but still below 50, still in contraction. Joining us now, Maria de Mertzis, Chief Economist for Europe at the Conference Board. Do you see any green shoots of recovery in this German story, Maria, or are you broadly still pretty downbeat on the Eurozone economy?
Well, talking about Germany first, I certainly am downbeat on Germany. The numbers, as you said, are still pointing to a contraction for Germany, so I don't expect a revision of our forecast for the German economy and therefore for the European economy. All the numbers are pointing in the wrong direction, including consumer confidence, export orders that are dipping into 4 years. Low numbers. These are not good news. And of course, the other thing that is coming in, which is rather negative in my view, is the investments on the chip industry. A huge support given to America, to many firms, including American firms, to invest in Germany on the chip production to support the electric vehicle industry, and that is actually stopping now on the back of negative numbers in terms of the uptake of electric vehicles in Europe. So all of these things, which have a medium-term perspective, are not very positive. Germany hasn't convinced the markets that it can actually do better and revive its manufacturing growth. And this is the bit to watch. How do investors and investments take up in Germany and therefore help the German economy and the European economy at the same time?
Okay, and Maria, I know we've talked to you before about the Draghi report, and you find a lot to like in the Draghi report and the suggestions that the former ECB chief makes. He's broadly calling for a lot of reform, and he wants a lot more money to stay invested in Europe. How do politicians join the dots then? Because they look at this negativity in the data out of France, out of Germany, and maybe they want to take action, but it might be difficult to make that link between the weakness now and what Draghi is suggesting. Can you give any words of advice as to how they do that?
Patience is very important, but in order to have that patience, you also need to have hope. And for that, I'd like to see an industrial policy strategy that spans across the EU. Look, there is issues of economic security that are of prime importance in the European economy. This is what I would like to see handled. The example of the chips investment in Germany is a case in point. This is of crucial importance for European industry. I would like to see the weight of the whole of the EU behind the support of critical industries that are going to help the economic security issue. And the fact that the EU is not supporting Germany in this is actually the one thing to fix. And I would argue that this is exactly what Draghi argues in his report. Find those industries that are critical for the European economy, either because they are frontier industries or because they are crucial for economic security, and throw your weight behind them. But of course, in Europe, when every time we support one industry, somebody else has to be supported elsewhere, irrespective of whether it is necessary or not for economic purposes. This has to stop. We need to have a holistic industrial strategy, very much in the likes of the way that Draghi explains it, and shift the weight behind this support. A grand bargain type of thing has to happen in the European Union in order to make advances here. I would like to see the chip industry being supported in Germany and the Netherlands, and in the process of doing that, design a strategy of how we're going to achieve our strategic objectives in the medium run. This is not for next year. Even though I'm quite pessimistic on Germany, I would argue that if we manage to follow this advice that comes from the Draghi report, we will see benefits in 5 years from now. That's absolutely essential.
Maria, but so much of that strategy that you're outlining, I think, would argue relies on subsidies, something that you've seen, of course, happen in the United States, which you pointed out as well with the IRA. But Emmanuel Macron makes a crucial point, which is that how can Europe compete if they don't subsidize in the same way that the United States does? I'm curious if Europe even has the money to provide those kind of subsidies. What do you do when the budget is in tatters and you still need to help the economy.
It is true that national budgets are strained, but to argue that the European Union doesn't have the money to support, I think is not correct. If we were to issue common debt, and of course there's a big if here, but if we were to issue common debt, there will be absolutely no problem financing that debt. We need to convince Germany and we need to convince the Netherlands. If we are going to finance our industries, your industries, because they are important for the security of Europe, something else needs to give. And I would argue that issuing common debt to finance strategic investments elsewhere is the way to do it. That's the grand bargain. Find the willingness to support frontier industries in Europe, which inevitably are in the geographical center of Europe, that, there are countries like Germany or the Netherlands. Finance those because they are frontier. This is where productivity gains will be quick to achieve, but then give something else in terms of strategic investments to the rest of Europe in order to make sure we continue with the green transition and therefore finance growth in the rest of Europe. This is, in my view, the way to go.
That all sounds great, Maria, but in 2 weeks' time we could have a trade war with Donald Trump. What's that going to look like?
That's right. We saw the European Commission actually following some of the suggestions of the Draghi report, which was on trade differentiation, sector by sector, industry by industry. Find those that matter to us and go for it. I'm not sure this was the right thing to do. It was, one would argue, a quick gain in this respect. But who benefits from these EV tariffs? You saw immediately that the investments on chips for the electric vehicle industry actually they're standing back. I'm quite skeptical about who wins from these tariffs. But this is Europe. Small, a few steps forward, a few steps back. I'm hopeful net gains are steps forward.
Hopefully. Maria, thank you very much indeed. Maria Demetzis, Chief Economist for Europe at the Conference Board. I want to talk about some of the equity markets in Europe this morning and what they're doing. The CAC 40 has got some really interesting stock stories in it this morning. Hermes is definitely one of them, but Edenred is another. The stock halted for volatility for a while. It is certainly under pressure. I've got it down by 14% on my board. The numbers have missed. The operating revenue coming in certainly significantly light. It's certainly seeing a big hit in terms of its EBITDA as well, what it sees in terms of that going forward. It's being reacted to very strongly in terms of this miss in this single stock. This is one of the stocks that took a while to get open this morning and has been really jumpy ever since.
Yeah, absolutely. That's the Edenred story. And as you say, a really big sell-off. In terms of points off the CAC 40, it's actually Michelin that's taking more points off there. And that, obviously, that not picking up any of the positives around the Renault story, instead reacting to the fact that the business has trimmed its guidance. So the Michelin story, again, around cars, around tyres and around everything's auto, all looking a bit gloomy still there.
I guess that makes me the ray of sunshine with some of the luxury names here. You got Hermes rallying, you see Kering as well up there. Even Total is taking a little bit of a beat, and I believe it's called Danone. It's always going to be Danone in my head, but Danone.
Yogurt. Can you draw a line there between French politics and what's happening in terms of the chaos we're seeing around French politics? The PMI data we're seeing, which is pretty bleak this morning, out of market in terms of the data that is being delivered, and what is happening in the CAC 40 right now.
Yeah, maybe. I mean, that's why I was asking Maria Demetzis to help politicians join the dots between the weakness in the data and the things Draghi says need to happen. How do they pitch those? How do they sell those to a population that wants things sooner rather than later? And maybe some of these take a while to deliver. Shall we talk about some of the things that are still coming up? Bloomberg in conversations, some great conversations happening today. 1:30 p.m. UK time, an interview with the Bundesbank president, Jochen Nagel. Well, what will he have to say about this increasing expectation around a 50 basis point cut from the ECB? Later, we'll hear from the Banco Santander executive chairman, Anna Botín. That conversation later. The UBS CEO, Sergio Ermotti, joining at the US close. You can catch all of those conversations starting from 8:30 p.m. UK time. So a lot of that coming to us from the United States. That is it. The opening trade. A busy day. Stocks are up. The Pulse is next. This is Bloomberg.
Is on. everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Traders now favour a 50 basis point rate cut from the ECB. That's as French PMI data disappoints. Euro area numbers break shortly. Boeing faces up to more strikes as workers reject the latest wage deal. The embattled playmaker warns it expects to keep burning cash next year. Plus, Tesla shares soar in after-hours trading after reporting its most profitable quarter in more than a year. Elon Musk sets out an ambitious rollout of robo-taxis. We're going to bring you the pre-market move shortly. Let's check in on the European markets map because the equity story is firmly there in terms of the earnings prints coming through. Positive on a number of fronts when it comes to Barclays, Hermes, Danone as well, all in the mix, lifting European shares higher so far in this Thursday session. The FTSE 100 here in the UK up 0.7%. Over in France, the CAC 40 gaining 0.6, despite the fact that PMI data there was soft on both services and manufacturing. Talking of which, on the data front, Euro area PMI is crossing the terminal right now. October, services PMI falling to 51.2, a bigger drop than forecast. The expectations were for a print of 51.5, services coming in at 51.2, a little miss there, a narrow miss. Euro area October manufacturing, meanwhile, you're seeing an increase, 45.9. The estimates had been for 45.1. Still firmly in contraction territory, of course, but German manufacturing giving the lift there, and we saw that data print earlier in the last hour. German manufacturing still in contraction, but slightly less bad than had been expected. Back to these markets then, the DAX is currently gaining 0.6%. The positivity coming through across these European equity markets, and the future setup in the stateside is currently positive as well. Let's flip the board and have a look at what's happening across the bond space. Pretty intriguing moves, certainly when it comes to the divergence between gilts here in the UK and treasuries. The sell-off that you've seen in US bonds taking something of a breather in the session today. You are seeing a bid for US treasuries, 420 on the benchmark 10-year, yields down 4 basis points. Different story here in the UK then. At the front end, 414 on the 2-year, a sell-off in gilts. Passing words from Andrew Bailey of the BOE suggesting that services continues to be a concern for him and the central bank. Yields are up close to 5 basis points at the front end. Euro dollar 108, gaining from softness in the dollar. The Bloomberg dollar index, the last time I checked, was down 0.2%. The euro then getting a lift of similar measures. Brent $76.30, currently up 1.8%, and that is also tying into the positive session we're seeing here in the UK on the FTSE 100. The show starts right now.
newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua here in London. Now, two major US corporate stories leading the show this morning. Boeing workers rejecting the latest offer to end their strike, and Tesla deliveries and coming through with some blowout earnings. Also a line there as well in terms of a pickup in volumes expected from Tesla. Let's check in on the market price and then pre-market. Tesla popping, look at that, gaining close to 12% pre-market, almost offsetting the downside, around 14% year to date up until today. We'll see how that story transpires and whether or not investors will want more detail in terms of the outlook for next year. But certainly Elon Musk was sounding very positive, and the beat in the quarter feeding into the upside for Tesla shares pre-market. Boeing, very different story, of course. Members of that union rejecting that pay offer of around 35% increase. So that continues to be a challenge for the plane maker. Their earnings coming out as well yesterday, expected to continue with the cash burn through 2025. The stock down at 3% pre-market. Let's bring in right now Kate Duffy from our aviation team. Oliver Crook standing by in Berlin. Kate, let's start with you. First of all, in terms of the Boeing story, why did they reject this offer?
Well, about 64% of Boeing workers rejected the new offer, and the new offer was a 35% wage increase over 4 years. So that's the majority of workers that rejected this. But what we're looking at here, the real sticking point, is the pensions, and this is something that they lost in 2014 in a deal, and Boeing isn't yet prepared to include that in the contract
This
offer.
is defined benefit pension award
that's
that they
right.
don't yet have, that they lost in 2014. So that's the
Exactly.
sticking point. What does this mean for Boeing then? How do they react to this? Do they go back to the discussions, the negotiations? Do they play hardball? How do you think they react to this?
This means that Boeing and the union will have to come back to the table yet again. So this is the third time that they're doing this. It's all kind of wait and see game. We're not sure what's going to happen here. But basically, it's not looking good for the customers of Boeing, especially like the likes of Ryanair, Lufthansa, BA. They're all looking and searching for planes at the moment. Their fleets are aging, and Boeing just can't get their jets out of the door quick enough. They are producing round about one a day, and it's not enough for these growing fleets. You know, Ryanair, they've had to cut their passenger forecast, and they've also had to cut flight frequencies in their network. And BA and Lufthansa, they're looking for new deliveries of the 777X plane, and that's not going to come until 2026 because of the strike. So this is what we're seeing at the moment. There's a real backlog in deliveries.
It's hitting all ends of the ecosystem, isn't it? From the suppliers of Boeing to their customers. How does Kelly Ortberg adjust to this then? He was pretty frank about the cash burn expected in 2025. How does this new CEO navigate these multiple challenges?
Yeah, it's super hard. And yesterday, after earnings, he came out and he was very blunt about it and said, you know, we have to streamline Boeing. We have to focus all of the operations now into one, and we will see where that's heading. Obviously, they have the layoffs on the table as well. That's 17,000 workers that Boeing is planning to lay off. And he says that he wants to fix things, but the thing is that the strike has to be over before he can fix anything. You know, he wants to rebuild this culture. He wants to sort of put in these new business derivatives, and we'll see where that goes.
Okay, Kate Duffy with the important update on Boeing. Thank you very much indeed. Let's switch focus to the automaker that is Tesla, of course, and bring in Oliver Crook standing by for us. Ollie, we're seeing the upside coming through pre-market for Tesla on the back of this beat and the outlook as well for the company. What did Musk deliver?
Yeah, so listen, Tom, I mean, we talk about the car maker. Actually, a large part of their revenue is actually not from car making in the third quarter. Almost 10% of it came from battery storages, which is a record for them in the quarter. Though we should say they also did sell a record number of cars that they've ever sold for the third quarter. They sold 460,000 cars in the third quarter. That is the third best that they've done in any quarter. So, Tom, amid all of this sort of questions about demand in the auto sector, slowdown globally, certainly in the question of EVs, this sort of number from Tesla is coming in a moment for this car industry where you've got profit warnings across the board and really bucking the trend. So really sort of with the numbers bouncing up and down, this sort of significant. And again, also we should mentioning, Tom, that there's other parts of this business that are growing, like the energy storage. They also made a ton of money, Tom, on their sort of EV credits, because as all these other car companies need to comply with really strict regulations across the world, we have new ones coming in Europe next year. Tesla is basically able to sell the credits of their own EV EV sales to these other car makers to make even more money. So with all of this sort of stuff jumping up and down in terms of their actual numbers, again, you looked at the EU September car sales, Tesla was up 30% in the month of September. So again, some positive stories in an industry that is otherwise facing very intense headwinds.
Yeah, as you say, look, it's important to break out the details, isn't it, in terms of the key catalysts for Tesla right now in these earnings. Ollie, there was also the promise from Musk to deliver in the future. We've heard a number of promises from him in the past. Of course, not all of them have come to fruition. How much should we put in these expectations, these forecasts that he's building out for the future of this business?
Yeah, so listen, Tom, we can deal with this sort of Musk fantasies. But again, Musk's great talent in certain things is actually being able to deliver on fantasies and build companies where other people just wouldn't even bother to try. Though saying that you're going to deliver 20 to 30% delivery growth next year may be a little bit on the bullish side, I think is fair to say. He's also saying that Tesla is going to be the most valuable company in the world. What's interesting is about the how he intends to get there. So one of the things that they're going to roll out next year is a more affordable car. This is not the mass market car that they had been talking about at a certain point, but something a little bit lower in the price range, which should hopefully for them stimulate demand. But then also this cybercab, right, Tom? We saw that sort of Hollywood show that Elon Musk put on a couple of weeks ago and really talking about the future of the business. The problem with some of these things and also the ride sharing that he promised to roll out in Texas and California is it requires a lot of regulatory approval as well, and the technology can't be there. And Tom, here, it's probably worth mentioning the politics of all this. Musk has been a very strong advocate of Donald Trump in the presidential race. He's supposed to lead the Department of Government Efficiency potentially under Trump. So there's also a political potential tailwind for Musk if Trump were to win the presidency. And, you know, could he sort of get his agenda in terms of getting the regulations through in order to get this autonomous driving a little bit faster? I think that's another interesting part of this story, Tom.
Yeah, that is a fascinating prospect, isn't it? To what extent the funding that's coming through from Musk to that super PAC is going to pay off for him if Trump wins. Oliver Crook, thank you very much indeed on the details around the Tesla earnings and the prospects going forward for that business, and of course the CEO, Elon Musk. Coming up, we're going to discuss the latest in terms of the European PMI data and markets next. There's certainly a market reaction on the back of the French data. We'll get the details for you. Stay with us. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back now. Views among ECB officials about where to take monetary policy are starting to diverge as the 2% inflation target approaches for the central bank. Traders, however, now favour just a half-point rate cut by the central bank in December. Let's bring in Laura Cooper, Global Investment Strategist at Nuveen, for a take on how to adjust around these markets and expectations on these central banks. Laura, is there an expectation that you would lean into? Would you lean into a jumbo cut from the ECB at the next meeting?
So I wouldn't yet lean into a jumbo cut from the ECB. I think there's been this greater scrutiny, certainly on the PMI prints that we saw today, but we're not getting a clean read that there's these downside risks to growth are actually building. And I think importantly, it's going to be about the inflation data. We have those clear prints next week. We are expected to see more of that goods price resumption pressures build, as well as we are expected to see, services inflation. Yes, it's broadening from a disinflationary perspective, but it's still quite elevated. So to our mind, it still suggests a gradual pace of cuts, evident to what Christine Lagarde is really continuing to emphasize.
Gradual pace of cuts. I have to say, I saw your notes dropping before the data came out. You said you're pushing back against 50 basis points. Then the French data came out, and I thought, oh, that's a challenge for Laura. And then the German data came through, and it kind of underscores your point, doesn't it, to some extent? So markets now pricing in around 35 basis points by December for the ECB. How do you think about, what's the read across to the European equity market then? Less aggressive than maybe the markets are expecting in terms of rate cuts, but the benefits are still there for some sectors. Tie that in terms of what we're seeing on the earnings front, and how you're positioning on how much exposure you want to European equities and which parts of the European basket.
Yes, it's interesting because the European equity kind of landscape has been propped up in part by aggressive easing expectations, as well as kind of this multiples expansion. And to our mind, it's really going to be about earnings that's really going to have to do the heavy lifting from now on if we start to see some of those ECB easing bets pared back. So from a top-down perspective, I think there's still this need to be cautious on European equities. Yes, there are kind of those idiosyncratic earnings stories that do suggest to be selective across different sectors. Financials, for one, I think are going to continue to outperform. Utilities are another. I think the key kind of focus for us in the near term, though, will be around the rhetoric coming from kind of the potential election in the U.S. outcome, and that may kind of weigh on sentiment going forward, and that has implications for the equity market.
Yeah, absolutely. Okay, so you favour financials, utilities in Europe. Let's go to U.S. politics then. Do you want to be leaning into the Trump trade at this point?
Well, I think markets are probably getting a bit ahead of themselves. I think certainly pricing in for a Republican sweep is premature. This is a very different dynamic than what we saw in 2016. I think what's been interesting actually in the U.S. rate sell-off is a part of that is kind of reflationary positioning. We are seeing inflation expectations rise, but we are actually seeing that term premium rise quite sharply. So to my mind, I think investors are going to demand greater compensation for taking on long-end bonds, even though at current levels they are attractive. I think momentum works against that, and as well the U.S. election outcome, regardless of who is actually in that seat, we are going to continue to see extended fiscal deficits that does suggest we're going to see greater need for higher term premium. So there is scope for yields to continue to extend higher, I think, at this juncture.
How much higher, I guess, is the question. We're at 420 right now on the 10-year. Some have come out, bold calls around 5% by the end of this year on the 10-year. Does that seem like a reasonable expectation? Where do you see the 10-year ending 2024?
I think what's kind of been most challenging for investors in this current climate is the fact that we are seeing this rates volatility become pronounced. And I would suspect that's going to become really the key theme heading into the election until we start to see signs of what that outcome could actually be. I mean, our year-end target is still 4% for the 10-year. We think that's really where fair value is. A lot of that is being driven in part by, this extended sell-off probably gone a bit too far. But I think looking over the medium term, it's all about the inflation dynamics, the Fed dynamics, and we don't yet have clarity on that because we are still seeing this growth exceptionalism, fiscal deficits, a confluence of factors.
Okay, so there's a short-term to the medium-term view on the 10-year there. How is there complacency in the U.S. equity markets given the sell-off that we've seen and the repricing in the bond market?
I think it's been interesting, the fact that the U.S. equity market, yes, we continue to see record highs in the S&P 500, largely being driven by expectations for Fed easing, this firm economic backdrop, and as well this resilient earnings growth. So the key question is which of those pillars could potentially fall? We're going to see quite noisy economic data in coming weeks on the back of hurricanes and strikes and the payrolls, so that we won't get a clear read on the economic cycle. So then it does tilt us more towards earnings. The bar, of course, is exceptionally low. what's been interesting is actually the price reaction on the back of earnings. So those that have beat are actually not being kind of outperforming relative to history, whereas those that are missing are actually in line with what you would expect on a 5-year average. So to our mind, it does suggest perhaps the bull market is on thin ice. Still a need to be quite defensive, looking at pockets of sectors. Again, we still like tech despite stretched valuations, but it's really about dividend growers. It's about looking at kind of more of those defensive healthcare utility sectors.
Okay, a bull market on thin ice in the US. When it comes to the UK, do you want to be building positions in UK equities in the run-up to the budget on expectations, whether it's house building or banks on the other side? How are you thinking about the UK budget and how to factor that into your portfolio?
I think the way we're looking at the UK is really actually from the rates complex. I think it's been interesting that we've actually seen...
more about rates than the budget.
More about rates than equities, actually, the way we're looking at the positioning. Yes, I think because at this current juncture, it's been interesting just how much gilt have sold off in tandem with U.S. Treasuries against a backdrop that we don't think necessarily is warranted. I mean, yes, we're going to see tax increases. We're potentially going to see changes to the debt metric, which does bring about this uncertainty for investors. But if we look at where gilts are trading now, I mean, gilts to boons, they're retesting the wides that we've seen so far this year. We think there is value in gilts in this backdrop where we're clearly seeing the Bank of England suggest that disinflationary pressures are building much more quickly than they had expected. They could cut rates a bit more aggressively. We think there's scope still for some of that value to be unleashed in gilts.
Yeah, that spread of the UK 10-year, the gilt 10-year versus the German bunds, almost 200 basis points to your point. Okay, so maybe the sell-off in gilts, which is we're seeing again today with yields up 4 basis points on the 10-year, it has gone too far. Laura Cooper, thank you very much indeed. Excellent analysis across these markets as always. Laura Cooper, Nuveen's global investment strategist. Coming up with less than 2 weeks to go until the presidential election, our new poll puts Donald Trump and Kamala Harris in a dead heat. More on that next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
DOJ or other authorities
could face big
bigger challenge.
What's next?
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. Now, the latest Bloomberg News Morning Consult opinion poll shows Donald Trump and Kamala Harris facing an extremely tight race. Both candidates are effectively tied among likely voters in each of the 7 swing states. Let's bring in Bloomberg's opening trade anchor, Kriti Gupta, for the latest on this. What have we learned from this polling? Because up until now, it's been pretty clear this is a tight race. This polling is focused squarely on the 7 swing states. How does it inform our views as we count down? Fewer than 2 weeks to go.
Well, I think we know the most is that we don't know. And I think that's the top line here, simply because the margin of error was already quite small.
Yeah.
Now you look at this polling, it's gotten even smaller. The one place, the widest point of that very, very tight margin is in Michigan. I thought that was fairly interesting in terms of, according to the labor vote, this was a real point of contention in terms of campaign strategies. The labor vote, the unions, for example, that have traditionally followed kind of a blue wave and pushed Democrats. Bernie Sanders over at Vermont is a big advocate for that. This time around, Trump did something that GOP candidates usually don't do, which is try to access that vote. He was unsuccessful in that. 2 out of 3 major unions in the state backing Harris instead of Trump. But you can see on that visual right there that the margin, the biggest margin, is in Michigan, and it is coming to Kamala Harris. The other spots that you want to keep an eye on are, of course, Arizona and Nevada. That is where Trump is campaigning today. He's going to be trying to get those votes as well. And then Pennsylvania kind of goes back and forth, and that a lot of political strategists would say is going to come down to Pennsylvania at the end of the day.
The essential nature of Pennsylvania, that you need that in the basket in terms of those electoral college votes. In terms of, it's pretty interesting how the numbers are breaking down. You talk about Michigan, you talk about the unions, because of course the unions can back a candidate, but doesn't mean the members are necessarily, they have their own free vote, of course, so it doesn't necessarily filter all the way down. What do you think, you talked about that being a Trump strategy. What do you think the strategy is for both candidates then in the days ahead?
Well, it's interesting because the Trump campaign is kind of turning itself around in terms of some of the things that traditional GOP candidates say. For example, Democrats tend to push for early voting. It is a big kind of very normal thing for Democrats to do to, again, court things like the female vote, for example, or to court a younger vote, court even a Hispanic vote. The idea being that we know what the policies you care about. Let's lock in that vote early, whereas GOP candidates tend to push for voting day itself. Trump is doing the opposite, which I think really speaks to the idea that a GOP candidate is pushing for that early voting simply by saying, if you're going to vote for Trump, you already know that you're going to vote for Trump. And that's something we've heard from the political strategists as well. But in terms of the strategy from the Harris campaign, it's important to keep in mind as well that she is making this a binary choice as well. You either vote for Trump or you don't. And that's where you've seen the comments of the last 24 hours really take the networks by storm.
Yeah, absolutely. And of course, it means if they do that early voting, they can zero in on the voters who have yet been persuaded. It helps the teams on the ground, doesn't it, on both sides. Kriti Gupta, thank you very much indeed on the update and what this poll tells us as we count down, of course, to that crucial US election. Coming up, we're going to discuss the path ahead for rates and the wider market outlook with the head of the BlackRock Investment Institute, Jean Boivin, is joining us next. This is Bloomberg.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product
It's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Good morning and welcome to the Pulse. I'm Tom McKenzie in London. These are the top stories for your day. Traders now favouring a 50 basis point rate cut from the ECB as French PMI data disappoints. The wider euro area fails to grow for a second month. Boeing faces up to more strikes as workers reject the latest wage deal. The embattled playmaker warns it expects to keep burning cash next year. Plus, Tesla shares soar pre-markets after its most profitable quarter in more than a year. Let's check in on these markets then, and certainly earnings are feeding into the optimism we're seeing across European stocks so far this Thursday, having beats coming through from the likes of Barclays, Hermes, Danone, the yogurt maker as well, all tying into some upside in terms of the equities picture. European stocks are currently up around 0.6%. On the data front, we've been talking about the PMI data out of France and Germany. Here's the redhead then when it comes to the UK. Services PMI falling to 51.8. The forecast had been for 52.4. So that's a pretty sizable miss in terms of October services PMI for the UK. Still in expansionary territory, but below the forecast. When it comes to manufacturing, that is also a miss for the UK. UK October manufacturing PMI falling to 50.3, so just holding on to expansionary territory by the skin of its teeth. The estimates had been for 51.5. Let's check in on the pound on the back of this move then. Currently the pound's just up 0.2%, versus the US dollar. The gilt markets have been selling off, and that sell-off has been paired to some extent in the session. Markets expecting still another cut, of course, from the Bank of England after they stayed put in September. Markets for the UK, traders expecting a 25 basis point cut at that next November meeting. That hasn't changed much on the back of this data, but you are seeing a bit of movement in terms of the sell-off in gilts has moderated to some extent. Traders now favouring, by the way, a half point. So from the BOE to the ECB, a half point interest rate cut from the European Central Bank in December. We saw poor manufacturing data out of France. Services data was also weak, adding to that impetus around a larger move. The wider euro area also failing to grow for a second month. Views, of course, among ECB officials on the rate path are starting to diverge. The BlackRock Investment Institute thinks the ECB will step up the pace of cuts. The Institute's head, Jean Boivin, joins me now for the view. Jean, maybe we'll get your views on the UK data in a minute, but let's start with Europe then. Markets are starting to lean in to expectations of a jumbo cut from this ECB. Would you follow that move? Is that the expectation with you and BlackRock?
Yeah, I think if we talk about the Europe in particular, and I wanna contrast that in a minute from a broader story, but like in Europe, there's clearly like a slowdown. There's more of a traditional easing cycle that is required.
I think there's a danger, however, that we start to extrapolate too much from jumbo rate cuts we're seeing everywhere. We've seen the Bank of Canada yesterday. We've seen the Fed earlier. So all of this dynamic, I think, in the case of Europe, there's a case for continuing to see disappointing data. However, I think there's extrapolation that go too far from markets, and the overall amount of easing we'll see globally, I think, is not as much as we hear right now. So ECB, yes. More to come. Not sure about 50 basis, but there's more easing. However, these easing cycle expectations, I think, are overdone overall.
Okay, so more broadly, overall, easing expectations overdone. So markets ahead and over their skis a little bit on that front. You do think the ECB is going to step up with further rate cuts. You're not sure about jumbo. When do you think they get below 2% in terms of the main refinancing rate for the ECB? Does that come in the first quarter, the first half of next year?
I think this is very unclear to me, at least so far, because I think you could see a case now, given the current momentum, where we get there at some point in 2025 first part. But at the same time, our core view is that the inflation story globally is not over. And I think over the course of the next few months and quarters, this narrative will change around that, and that can give them some pause to go further. So I think we see some easing, some conviction over the next quarter, let's say. A case maybe where we get closer to 2 in the first half of next year, but I don't think that is a given.
How much of an incentive would that be then for investors to get further exposure to European markets? The growth is clearly not there. It's certainly challenged, but you are getting these rate cuts pushing into 2025 is the expectation. How does that lead into your view around how much exposure you want to European stocks?
Yeah, no, I think this is the challenge right now. So, and to us, the risk asset story, and the reason why we're bullish on risk assets more generally is not so much a macro story. It's not about rate cuts. It's really about the powerful engines of growth that we're seeing in some places, and it's about what we call mega forces, but AI in particular. So it's more thematic. I think that leads us to be bullish on some risk asset and equities, but that tends to favor right now the U.S. as opposed to Europe, given that the AI story is really much U.S.-centric right now. So it's not so much a macro rate cut story, but more about these forces.
Yeah, and BlackRock and you and the team have been clear about the AI theme and the persistence of that. You've pushed back on the concerns around ROI, for example, in terms of the CapEx spend and the investment that comes. You still think that's a key driver. But you're also talking about a broadening out of the market in the U.S. Does that come at the expense of big tech at some point?
I think there's a couple of things here, right? The first thing is that this AI story, which is the transformation of the makeup of the economy, I think has to imply some concentration as a result of that, because the big player, the one that can build out the AI, have to be at this moment the bigger players. It's difficult for a new entrant, small, to have the balance sheet to build data centers. So as a result, I think the concentration we see will remain a feature of this market, but as we get more enthusiasm around that, as we start to see some adoption in other sectors and so on, that's where the broadening out will eventually come. But so we see some coming, but it won't be at the expense of megatech. It's going to be actually caused by the megatech.
Are there any obvious tactical trades to be placing ahead of the US election right now? Or would your advice to clients be stay on the sidelines until we get clarity?
I think it's a full errands game to try to trade the US election. You told me, you would tell me today, I know for sure which party will win, and I would not know how to trade it, to be honest. I don't know how the market will react on the next day. For us, the main thing to watch is really more the contested election scenario that could be weeks of very disrupting legal battles.
Is that underpriced by the markets, do you think, that scenario?
I don't think that's in the price, and that's where, if you want to, prepare for some scenario where you need to react, I think it's one of those scenarios that could be bad for markets on November 6th, sorry. So that's one thing, but other than that, I think it's very difficult to know, which way the markets will go once we learn the outcome. And I think over the long term, the implications will be something we'll learn, because there's some things are being said. What will be implemented could be very different. So
there's one argument. I hear that absolutely. There's one argument that what is uncontested is that there will be further fiscal expansion from whoever is in office. So how does that inform? Does that mean you're shorting the long end of the Treasury curve? How do you want to be thinking about that scenario? There seems to be a little bit more consensus on that view.
So there's a few things, but totally, I think that's not about the outcome of the election, because we take it as a given that deficits are coming, will continue. It has been our view for some time that we're in an environment where inflation is already an issue that is not fully resolved. Central banks will not be able to cut as much as the market is currently expecting. And on top of that, we think post-election, it will be clearer that this deficit story is real, right? And so I think this is an environment where long-term rates eventually start to go up. We've seen a very significant repricing over the last month, since September, right? 60 basis points. We think that has room to continue over the long run. And so it's not really an election trade. It's more like it's kind of baked in the macro environment
when does it trigger the bond vigilantes in the US? The US has seemed to be immune to the bond vigilantes in recent years. Are we approaching a tipping point?
I don't think we're approaching a tipping point. I mean, bond vigilantes, like sharp movement due to like sudden fears about things getting out of control. I think it's a tail scenario at this stage. Partly because the U.S., reserve currency and all of the importance it has globally prevents. It's costly for bond vigilantes to go hard like they might have been doing in the UK 2 years ago, right? So that dynamic is different. It's not impossible, but I still think this is a...
Well, talking of the UK and drawing on your experience at the Central Bank of Canada, how much room do you think Rachel Reeves, the Chancellor, has to expand borrowing here before the debt markets start to push the panic button?
Yeah, I think the bond market has already been pushing a lot of concern on the fiscal side. So we've turned very more positive on UK gilts because we think these concerns are overpriced, and the Bank of England has room to cut, and the economy is not necessarily in a great shape. So all of that means that the yields movement we've seen, the high yields, are not fully justified at this stage. So it doesn't necessarily give room to spend because, I mean, this is a pretty fragile equilibrium. But I think there is some room, and in fact, we're a bit more constructive on the fiscal outlook and what it means for yield than what
okay, yeah, very interesting. The budget, of course, will be announced next week, so we'll be watching that with a close eye, as I'm sure you and the BlackRock team will be as well. Jean, thank you so much, walking through a number of different macro economic topics, and of course, a closer take on these markets as well. Jean Boivin, who is the head of BlackRock Investment Institute. Coming up, bank earnings bonanza. We're going to unpack a busy few days of results from some of the big lenders with Vicky Farmaki from State Street Global Advisors. So a deep dive on the financials. That's coming up next. This is Bloomberg. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back. Now, Barclays shares have jumped after reporting earnings. The British lender's profit was buoyed by an increase in trading revenue in the third quarter. You can see the stock is up 4.3% so far in the session. It also expects Barclays' full-year net interest income to be greater than £11 billion. That's up from an earlier forecast. So it's been a strong year for the banking sector overall, both in Europe and over on Wall Street. Certainly a strong quarter so far, where US banks, of course, have delivered better than expected third quarter earnings as well. Let's discuss the broader sector and how the earnings story informs the next steps for these banks with Vicky Farmaki, Senior Analyst at State Street Global Advisors, with a lens on the financials. Vicky, thanks so much for joining us in the studio.
Thank you for having me.
Let's start with a broad question then. The earnings broadly, as we said, have been broadly positive for this sector. Are we at peak earnings given what's happening with rates for the banking sector?
Well, let's start with the setup for Q3. It's a very constructive one. I think we're going to get reassuring results. We've had some rate cuts, but it's early days yet to have an impact. So I think overall, the investors are going to look through the Q3, which is a pretty good setup, you would agree, and what the guidance will be. And here we have some banks that are possibly through peak earnings, so that's what investors are concerned about. But there are other banks who are less interest rate sensitive because of the way the books are balanced, the way the deposits are structured, and of course, the macro backdrop that they have. So I think you have quite a divergence going forward. Investors are going to look for that guidance of who's going to be more or less interest rate sensitive. A big part of that is where the ECB rate will land, where the lower bound will be going forward.
Yeah.
The 2 to 3% range is what bank management team tells us is a pretty good rate. Below that, below 2%, it starts to get more tricky. So I think that's what we're going to be looking for.
Okay. And that sort of time, and of course, the discussion right now is whether or not you get a jumbo cut even from the ECB. So that could be bad news for the banks. And you're looking at markets pricing in sub 2% on the main ECB rate by June of next year. So what is the lag in terms of lower rates and the squeeze on net interest income for these European lenders?
Absolutely. I think, again, it would depend on the country you're in and how the books are structured. We have countries like the UK and France and some of the Netherlands where hedges are in place, and that would definitely smooth how far the net interest margin impact will be. But then you have other countries in the periphery that are going to be hit quite quicker as they benefited quicker going on the way up. So I think you will have this divergence between different countries and how the different books are balanced. And then you have the diversification of the revenue streams. And we're definitely looking at that and where fee income will play an important part to offset some of that impact.
Okay, because the flip side is possibly higher loan growth as a result of lower rates. How are you seeing that in terms of offsetting a potential squeeze in net interest income? What are we seeing in terms of loan growth? Are we seeing a pickup there?
Well, so far has been pretty subdued. We haven't seen that come through quite yet. But we did see the ECB lending surveys come out for the third quarter, and we're seeing very positive signs there, especially on the household. We had household demand surge for the fastest rate since Q2 of 2015, actually. And even on the corporate side, we're seeing a pickup for the first time in a year. So the green shoots are there for low demand, but it's very early days. We're looking to go from about 0% growth to maybe 2 to 3%. For some banks, that's not going to be enough to offset the net interest margin. A hit from the interest rates. For others that have other sources of revenue, it will be able to continue to show earnings growth.
Maybe 2 to 3% growth in loan growth for next year, presumably. That's
yes.
the view. Okay, interesting in terms of the positive catalyst for these banks. Deutsche Bank came out with earnings yesterday. Of course, I know you don't talk about individual names. It was a beat top line, but real concerns about credit provisions. More broadly across the sector, are you seeing a marked and significant and material tick up in terms of provisions, in terms of credit losses at these banks?
For the sectors overall, we're not seeing any asset quality issues emerge. The starting point is very low. As you know, credit losses have been well below historical averages, and that's because we haven't had much loan growth. There haven't been aggressive underwriting taking place. So overall, asset quality remains very benign. But we do expect it to pick up. We expect the credit losses to come up from very low levels, and most bank management teams are guiding to that. But again, it's nothing that will be a systemic issue at this stage, and capital levels are very high. They are 15%, which is double what we had before the financial crisis. So they come into this with very strong capital positions and from very low credit losses. So we do expect a pickup, but we haven't seen any.
Okay, it's not a black swan for this sector. Okay, the provisions, or at least the balance sheet is robust enough. What about next year as a theme in terms of consolidation? The UniCredit stake in Commerzbank, what's happening, of course, with Sabadell over in Spain. Do we see real consolidation in this European banking space next year?
Well, we do need consolidation in Europe.
We need it, but we're going to get it.
Well, that's the question. I think we need consolidation. We need banks sort of scale and efficiency.
But each deal that's announced has to be assessed on its own merits, and the shareholders have to assess whether it's accretive. We see in-country deals make more sense, and there you can see the synergies materialize much easier. But what we're also seeing with banks is now that they have the capital, the flexibility, they can think more strategically about the businesses that they have for a couple of years. So they're thinking about M&A, they're thinking about bolt-on, where they can improve their capabilities, especially in the fee income side, because we talk that's going to be a key driver to offset some of the pressure we're seeing on the net interest income side. So we're definitely likely to see more M&A, whether it comes with big banks or more bolt-ons is to be seen.
Okay, so if we get more in, that's interesting. If we get more in M&A, does that mean we get fewer buybacks? Because banks have been pretty generous in terms of the return of cash to
right now,
shareholders. Does that become less of a catalyst next year?
Well, capital levels are very strong, so banks have the flexibility to do both at this stage.
Okay.
They have quite good capital levels, and they're managing that, and they're balancing the interests of the different shareholders. So a lot of them are able to put some money on the side for buybacks and also pursue their strategic initiatives.
Okay, both M&A and buybacks then in the pipeline for these banks. Great insights in terms of how this sector is shaping up to a modestly lower rate environment, but of course historically high, at least over the last few decades for the banking sector. Vicky Famaki from State Street Global Advisors seeing loan growth as well, increasing maybe 2 to 3% next year. Coming up, we're switching focus to the luxury space. Gucci owner Kering warns its annual profit will fall to the lowest level since 2016. That's as Chinese shoppers shun the luxury sector, at least parts of it. Not so much for Hermes. We're going to bring you the details next. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday, right here on Bloomberg. Context changes everything. Wednesday, Chancellor of the Exchequer Rachel Reeves delivers the UK's annual budget, the first for the Labour government after 14 years in opposition. How will the Treasury balance investing for growth while dealing with the deficit? And which tax increases will she use to meet the challenge? Live from Westminster, Bloomberg Television brings you special coverage, starting with a Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg, Context changes everything.
Welcome back. Now, the slowdown in Chinese demand for designer goods is taking a toll on some of the world's top luxury brands. Gucci owner Kering today warning annual profit will fall to its lowest level since 2016. The stock moves, of course, reflecting more the optimism that's come through as a result of Hermès, which is giving the broader sector a lift. Let's bring in Angelina Rascouet now for a deep dive on what we're seeing in terms of the luxury market. It seems to be, if you ignore today's moves, it's a tale of two luxury spaces. Hermès on one end and everyone else on the other. Angelina, what have we learned?
Yes, absolutely. Today we got the confirmation that indeed Hermès, because of its they target basically the wealthiest customers, and they tend to be the most resilient. So right now we're facing a downturn overall in demand, and but they said especially in China, their most loyal customers in the third quarter still splurged on its priciest products. So that's jewelry, that's ready to wear, and that's leather goods. And that's not the case for the rest of the sector. So today the shares are up, and overall, I mean, they grew by double digits in the third quarter. And importantly, the CFO told us that so far early this quarter, they're not seeing a change in trends.
Yeah, that trend's going to continue. What was it, 11% increase in sales versus what, 25% drop for Kering? Talk to us about Kering then, Angelina. They cannot blame everything, can they, on China? This is also about problems within the business.
Yes, exactly. There's a macro picture, but there's also problems of their own making. And Gucci, as you said, results were down. Revenue was down about 25% in the third quarter. And the issue is that when Gucci struggles, Kering struggles, because even though they have Yves Saint Laurent, they own Balenciaga, Bottega Veneta, that's not enough to compensate for the struggles at Gucci. And so indeed, the issue with Gucci is that it's been in turnaround for a long time now. So quarter after quarter, we get more negative results. So and so yesterday they warned that basically annual profit is set to be to reach the lowest level since 2016. So that's a big disappointment for the market. And there was also in the analyst call a few visibility for next year. So we'll see what happens. But it's true. I mean, they named a new designer early last year, so he's been there for about 18 months. He's presented a few collections, and we'll see if customers appreciate his designs. But indeed, it comes as the macro picture is really worsening, especially in China.
Yeah, the two things coming together, and the executives saying that they still support the designer, and the more kind of pared back, maybe less extravagant look that's come through as a result of that designer. Angelina Rascouet, thank you very much indeed with the take there in terms of the earnings that come through from Hermès and Kering. Very different picture from both of those luxury companies, of course. The stocks, though, across the luxury sector getting a lift, and that's helping the CAC 40 so far in the session gain around 0.7%. Pre-market, we are looking at Tesla and the pop that's come through on the back of a blowout quarter, and some guidance as well in terms of volumes, and they're doing very well in terms of the battery, the energy storage, but also the credits they sell to other automakers. Pre-market, Tesla up close to 11%. Boeing, though, the woes around its workers not accepting that deal, that stock is down 3%. Executives expect the cash burn to continue into 2025. Up next, it's The Brief with Danny Berger and Manus Krani in New York. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranley alongside Danny Berger. You're welcome to Bloomberg Brief.
An $80 billion boost to market cap for Tesla after a blowout quarter for margins and guidance. Bid rejected. Boeing fails to reach a deal with its factory workers, keeping the union on strike. And in a dead heat, candidates Harris and Trump are neck and neck in the latest polls with just 12 days to go until the election. Good morning, Manus.
Danny, good morning. It looks like a little bit of earnings optimism has taken some sand out of the gearbox. Excuse the pun. Tesla flying higher, up by 11% this morning. So the angst of these markets over the past 3 days of a sell-off has just turned around incrementally, up 0.4% on the S&P 500. It was the mega Mag 7, which was actually anxious yesterday going into the close. Tesla delivered. NVIDIA ended the day down by 3%, and that's turning it around. Is there a sense of exhaustion, perhaps, in some of these markets? The bond market is where you've seen perhaps the most exercise on the upside. Twos up by 47 basis points, as we said yesterday, from the jumbo rate cut by the Fed. And I like what Ed Yardeni said. The bond vigilantes, they started to vote early, Danny. Bonds have lost 2%. You like that one? Lost 2% in the month of October. Good morning.
Good morning. It is this push and pull between what matters more for this market. Is it earnings? Is it the election? Is it the macro? It seems to be everything at once, which is why it's so difficult to disentangle these moves. But Bank of America said that there is this election volatility premium being priced in, and that's why stocks are drifting lower.
And then you look back, I mean, you've got all this euphoria about soft landing, Greece landing, no landing, and then you look at the beige book and it's like a blancmange that's sort of gone flat. Not that I've ever cooked a blancmange, but a blancmange is literally, little changed in most of the areas in the United States of America.
It does stand in contrast to some of the stronger economic data we've gotten. We know the Fed is caring more about that anecdotal evidence. Well, Manus, over the past few days, as we've been talking about, it's been a story of higher yields, stocks weaker. Let me just show you what we've done over the past week. Again, just emphasizing what you were just talking about. Joining us now is Nadia Grant, head of global equities at BNP Paribas. Nadia, theoretically, higher yields are supposed to pressure equities. How sensitive is this market to fiscal stories, to stories of stronger growth, which means higher yields? Do equities finally succumb to that?
Hi, and lovely to see you. So sorry, yes, in terms of the market dynamics right now, we're really entering the thick of earnings season. So I think the market is finally going to be far more susceptible to the intrinsic news, to all of the nice idiosyncratic, and so we're really keen to understand where the growth is going, particularly given where multiples are right now in the market, and so it's all the more important to see that earnings delivery on the S&P 500 to support the market further. So that's really what we are watching right now and what we think should drive this month.
Nadia, good morning to you. We had Julian Emmanuel sitting in the seat yesterday, and he talked about this ferocity of the move higher in yields, and that really those higher yielding Mag 7 don't really get challenged until two-year paper goes above 415. How much of a headwind is this spike in yields to the overall Mag 7 narrative?
I think what you've seen, and particularly what you saw earlier in the year, is when the market entered the year thinking about cuts in rates far more aggressively than what the Fed had guided for. What you saw is the Mag 7 leading the market and continuing to lead the market from the past year. And so they've really sort of not ignored the rise in yield that you saw at the time, but it was far more about the fundamentals. It was far more about the growth, about the secular trends within AI, and that propelled the market, and the huge earnings delivery that you saw in part of NVIDIA in particular, and others that really propelled those stocks. So I don't think that as it pertains to the Mag 7, that higher yields are per se a big issue, because they are exposed to this secular mega trend. And so as long as they can continue to deliver on the earnings front, on the free cash flow delivery, and these are fantastic companies, because it's not that they're trading at a very high multiple for nothing. They also have extremely high return on equities and very nice free cash flow yield. So you're paid in the present to own these companies.
Just to put a finer point on it, Nadia, does that mean you believe that their leadership will continue unchallenged next year?
It's a great question. I do buy into the broadening theme, but I'm not throwing away the Mag 7 as a result of that. And so what it means is that I do believe that as the economy is well underpinned, as earnings growth should broaden, and the gap between the sectors that earn and technology earnings growth should reduce, should narrow a lot. I do believe that you should see a broadening of, as you see that gap narrowing, as you see more sector contributing to the earnings growth of the S&P, you should see a broadening. As well, the Fed easing should further contribute to that, as it alleviates a lot of pressure on the earnings of those companies that are more interest rate sensitive. So I do buy into that, but it doesn't say it doesnend mean that I should abandon the great secular growth characteristics that I have in some of these Mag 7. So what we've done is more find a bit more balance and reduce some of our overweight into the Mag 7 and allocate it towards the sort of the belly of the market cap, the sort of 10 to 50 billion market cap is where we feel that you should have a bit of a relief. And likewise, we think that from a market leadership standpoint, what you've seen this year is you still have seen a lot of cyclical leading defensive. So we also like having a bit of exposure to those sectors that have been neglected by the market, that look very cheap. So you can get cheap protection from some of the defensive sectors as well. So the likes of the staples and utilities that trade within the sort of 6% of the cheapest they've been in their history relative to the market. So really, from a portfolio standpoint, we like to have many drivers of performance.
Nadia, we're going to spend a little bit of time talking about the very latest Bloomberg poll, which shows neck and neck in the swing states for Trump versus Harris as we count down to this election. None of these polls are indicating red sweep, blue sweep, or anything definitive. I want to get a sense from you. You talk about neutrality or a balanced as possible going into this election. What is a balanced position going into this election for you?
Yeah, it's really tricky, isn't it? Because the policies, the agendas are so vastly different and very different sectors that would benefit as a result. So what we've done in terms of, because we obviously have no edge in trying to call the outcome of this election, as you say, it's very much neck and neck. So what we're trying to do in portfolio is really finding opportunities that we think are bipartisan in nature, that can benefit from both agenda. And so you have things like IIJA, the Infrastructure Act, or the CHIPS Act, that are very much bipartisan. And when you think about, from a secular standpoint, the rise in geopolitical risk and all of the protectionist measures that have been announced, or those that are already in place, you can see that the theme of onshoring and reshoring and building in America, building at home, is a very strong theme. And so we've been leaning into that sort of a renaissance or rise in construction spending in the US, and very much like exposure to sort of aggregate and cement, because it shouldn't be swayed away by one versus the other.
Certainly those tax differentials are going to play and come to bear. Harris at 28%, Trump at 20% in corporate tax, and if you build in America or produce in America, it's going to be 15% if they manage to drive the tax policy through. Nadia, thank you so much for being with us this morning. Nadia Grant of BNP Paribas. Other stories trending on your Bloomberg terminal this morning. Barclays jumped to the highest level since 2015. That's after it reported a surprise increase in the third quarter fixed income trading and total income that beat the estimates. The bank also benefited from an increase in deal activity in the quarter, with advisory revenue more than doubling.
Hermes sales rose more than 11%. The Birkin bag maker met resilient demand for its pricey handbags. Its performance has managed to hold up despite the luxury slowdown. Its most loyal customers are still splurging on the most expensive products.
And Tesla delivered a blowout quarter, reporting its biggest profit in more than a year. An upbeat forecast for 2025. On the earnings call, Elon Musk promised to make the EV company the most valuable company in the world, starting with a 20 to 30% delivery growth for next year.
Speaking of which, we are going to be catching up with RBC's Tom Narayan, really one of the lead voices on Tesla, on their earnings later this hour.
And locked in a dead heat, as we've just said, with less than 2 weeks to run until the election. The race between Vice President Harris and former President Trump couldn't be tighter. We discussed the latest polls on Bloomberg Brief. Context matters.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
day one of the Trump administration, I will terminate Kamala's insane electric vehicle mandate, and we will end the Green New scam once and for all.
Presidential campaign, it's heating up as we inch closer to the election. The former President Trump there taking a jab at Vice President Harris's policy at his Georgia rally last night. This as Harris takes aim at her opponent in a CNN town hall.
General Milley calling Donald Trump a fascist. You yourself have not used that word to describe him. Let me ask you tonight, do you think Donald Trump is a fascist?
Yes, I do. Yes, I do. And I also believe that the people who know him best on this subject should be trusted.
So it's less than 2 weeks before Election Day. Candidates trying to do everything they can to move the needle for undecided voters and to get people out and showing up to vote. Joining us now is Bloomberg's David Gura. David, I just want to touch on what Harris was talking about, because this is different than when she first started her campaign. It was one of real positivity. It seems that her tone has changed, akin to Biden saying, this man isn't fit for office.
Yeah, she's increasingly leaning into the fact that she thinks he's erratic and unfit to serve. And what she was commenting on there are these two articles that came out this week, one in the New York Times, one in the Atlantic, both of which were quoting liberally John Kelly, who is Donald Trump's chief of staff, former four-star general, former secretary of the Department of Homeland Security, really expressing strong reservations about Donald Trump being reelected once again, and he in those interviews calling Donald Trump a fascist. So this was the strongest language we've heard from her since, using that term. I should say Donald Trump very comfortable calling her a communist and applying all kinds of labels to her. But I think it's a moment in which she's trying to, again, raise the stakes for voters who might be on the fence about going to vote, perhaps Republicans who don't feel comfortable supporting Donald Trump, and really couching this as kind of an existential threat to the country.
It's interesting, you know, she calls him unstable, unfit to serve, and then you look at his Georgia narrative yesterday, which I watched when I was at home yesterday afternoon, and it was very much around the reaching out to the minorities, and it really was leaning into the Latino vote, leaning into the whole sort of area that they spent last week on. So what was Georgia's incredibly important as well. He spent a lot of time in North Carolina, which is critically important, but Georgia also very important with early voting as well.
Absolutely, in a state in which he's doing very well. If you look at the latest poll that we have from Bloomberg and Morning Consult, he's leading by a very slim margin in North Carolina, in Georgia, and Wisconsin as well. He's very hopeful that he's going to win that state.
I mean, he won Georgia, in 2016 by nearly 6%.
He did, and so now you have it being a very contested state. You have Kamala Harris going there today. She's going to do a rally with former President Obama and Bruce Springsteen. So both candidates really fighting for that state. But you bring up early voting. This is something that both candidates are really leaning into. And in the past, it's something that you saw Democrats really pushing and trying to get voters to use. Now you're seeing Republicans and Donald Trump doing it just as effectively. And I mean, the turnout in North Carolina, for instance, or the amount of people availing themselves of early voting, more than 1 million people doing that in the first 4 days of that period. So it's becoming very popular, and one that I think both parties are leaning into.
You mentioned the poll, the Morning Consult Bloomberg poll, that's in a dead heat. Elsewhere, there does seem to be polling that suggests ever so slight, but momentum for Trump. There was an FT Michigan poll that we talked about this morning, that they trust him more on the economy than Harris for the first time. There was also a Wall Street Journal post that said views have turned more negative on Harris. We talked so much about that big bump that she got when she took over from Biden, the momentum there. Has that finally faded?
You know, I think that that's what her campaign fears the most. But if you look at our polling kind of in complement with that, you know, you see the economy as that kind of like top line number. It's been the thing that voters care about the most, and by such a wide margin beneath it are immigration and abortion rights. Look, he is trying to just kind of stay the course, maintain the momentum that he's got. And as you say, she had that bump after she was named the nominee and after the convention. We've seen that ebb somewhat so, but fundamentally this is such a razor-thin margin when you look at our polling, within a margin of 49% each. It's just extraordinary. And so I hate to say it's more of the same, but it's just kind of confirming the fact that this is such a close race. Again, we're just looking at these 7 swing states.
Yeah, and indeed, and in that one, it is still the economy where he has a clear lead, 50% to Harris's 45%. Who do you trust more with your personal finances? Again, it's a Republican administration. Look, he's going on Joe Rogan. He's doing this podcast. He's going to be at Madison Square Gardens. She's going to work with Bruce Springsteen. I mean, they're sort of going after the last gasp of attention. What do you make of the strategy in the next 10 days?
I think that there's been a shift from going after this very small sliver of the electorate, these undecided voters, Will they turn out? Who knows? Again, it's very small. I think the real focus now is on ginning up excitement and getting people to come to the polls. So it's those who might be on the fence, sitting on the couch, might not mail in their ballot or go to the polls on election day. So the infusion here of celebrity, of going on to this blockbuster podcast, the Joe Rogan podcast, which has such a sizable audience, I think is an effort to reintroduce themselves to audiences of people who, again, might be on the fence but would be willing to come in and vote.
What is it? Nearly 25 million people have done early voting, but the Democrats aren't leading as much as they did in the last time out. It's going to be an exciting 10 days. David, thank you very much. David Gura there with the very latest on the polls. Coming up on the show, we'll dig into Boeing getting hit pre-market. This is after the workers rejected the latest wage offer. Context matters on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg Brief. I'm Manus Craney alongside Danny Berger in New York. Front pages look a little bit like this. Headlines from around the world. We're going to kick off with the New York Times, leading that the editorial chief of Los Angeles Times is quitting after it refused to endorse Vice President Kamala Harris. Now, the board had planned to endorse her, but stopped by the owner.
Next up on the Bloomberg, UBS's CEO, Sergio Armati, said that his firm is starting to think about what happens, what comes next after the merger with Credit Suisse. It's been so much time focusing on this. Armati looking forward, saying that technological changes will have a big impact on where they go from here.
And the Journal leads with Boeing's largest union rejecting the new labor deal. Workers voted 64% against a new labor agreement and will extend the 6-week strike. Let's just dig a little bit more into this story. We've got Bloomberg opening trade co-anchor Guy Johnson with us. Guy, it's interesting. I mean, this is a blow, certainly a blow to Kelly Ortberg, but it looks like the margin of rejection has been compressed, but it's a bloody nose nonetheless.
It's still a difficult outcome for the management at Boeing. They were hoping that they could get this strike over and done with. But as you say, Manus, we come down from 94% voting against the deal to 64% voting against the deal. So that's a significant improvement. The union has, or the union's members have rejected a 35% pay offer. What is critical here, though, is what is happening with the pension. Many of those that work at Boeing would like to see the defined benefit pension scheme being brought back, and that seems to be the clear sticking point right now. So Boeing's got to go back to the negotiating table with its unions. It would like to get this over and done with quite quickly, so it'll be interesting to see over the next few days whether or not we can see another deal being put to the workers that maybe resolves that pension issue.
Guy, does the fact it was 64% voting against it versus the 90 whatever, does that suggest that we are just days away from an agreement?
It certainly would seem to suggest, Danny, that we are getting closer to an agreement, but the pension is clearly a major sticking point. Otherwise, I suspect that Boeing would have put it on the table a little bit earlier on. And it is key that it is clear that it is key to many workers. So this is a sticking point that a solution could be difficult to find on. So we'll maybe have to take some time to get this done. Remember, it took the acting Labour Secretary to maybe get to where we are now. How much more involvement do we need to see from Washington, D.C. to get this across the line? But the pension issue is going to be difficult. That may suggest that it may take some time to get resolved. But this is something that Boeing needs to get done quickly. So maybe it's time that everybody put their cards on the table and thrashed out a deal.
Yeah, I mean, on the defined benefit pension, this is where they've offered some money to the 401k, but again, that point of angst is on the defined pension. Guy, how much of a sword of Damocles is this rejection over Ortberg in terms of the cash burn and the junk the deliberation by the rating agencies? I want to be careful with that in terms of moving to junk.
Well, they're watching the situation very, very carefully. We had anticipated, it had been anticipated that Boeing maybe would start to get back to being cash flow positive fairly quickly. It would take a while, but this is now being pushed back into further out into 2025. This is the critical factor. We're still scratching our heads trying to understand exactly why it would take so long to get things back to normal, to get this company back on a more even keel. But Kelly Ortberg said it yesterday, it's easier to turn things off than to turn things back on again. And that is a crucial line. As soon as we maybe get a deal done, it's not like you can kind of flip the switch and Boeing goes back to where it was before. The whole supply chain needs to ramp back up again. You need to see the Boeing factories ramping back up again. This will be a process that takes time, and maybe that's why it could take a while for this company to get back to being cash flow positive once again. And as you say, the rating agency will be watching very carefully to see, the rating agencies will be watching very carefully to see how that process unfolds.
Guy, thank you so much. Bloomberg's Guy Johnson. We'll have you back shortly, and we'll get to some of the other American earnings, American Airlines, that is, in Southwest. Guy Johnson there. Man, as a quick look at markets this morning. Is it earnings come to save the day? S&P 500 futures up nearly 0.5%.
Well, it was 3 days of angst, wasn't it?
Yeah.
You know, and there was this sort of juxtaposition between the rise in yields, and there's a lovely piece this morning about what scale of a change in yields does it take to really unseat an equity rally. I don't do standard deviations, well, not since 1989, but apparently it's a 2 standard deviation move in the bond market.
The problem with that, though, is we had higher rates and Mag 7 still did well in this Fed hiking cycle. So,
yeah. I mean, look, the swings in NVIDIA, what was it, down 4% yesterday at one junction, swings higher this morning. Anyway, we're going to count down to this election. A little bit more on the docket. Excuse the pump.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
An $80 billion boost to the market cap for Tesla after a blowout quarter for margins and guidance. Bid rejected. Boeing fails to reach a deal with its factory workers, keeping the union on strike. In a dead heat, candidates Harris and Trump are neck and neck in the latest poll with just 12 days to go until the election. And we've had a break a trend in these markets, Danny.
We have. It was 3 days of losses, futures indicating that we will have a day of gains. Is it Tesla come to save the market? The NASDAQ 100 outperforms Tesla, up nearly 11% pre-market. Meanwhile, the bond market also backs off some of the losses that it's seen over the past few days. We're at a moment, 10-year yields down 5 basis points, where the most hawkish rate path is priced in since the summer turmoil. Yesterday it was 10 years up 3.8 basis points. We also had a soft 20-year auction. So we give that back. So a bit of reprieve this morning, Manus.
Yeah, I mean, look, this bond market repricing has been quite vicious. It comes down to whether you believe it's fully pricing a soft landing in this market. But my favorite line, I'll say it again, it goes to Ed Yardeni. Bond vigilantes started voting early. The question is, are they done?
There's a lot of differing opinions about this. Steve Englander says that what we've seen in the bond market was just about the strong NFPs we've gotten. That is just about recalibrating where this economy is. FX market, he argues, that is about the Trump trade, but he thinks the logical conclusion is that yields could go higher if there's a Trump presidency and a red sweep.
I think you could probably call that a bit of a parabolic move, if that is what comes to pass. And the very man to discuss that is David Wu, CEO of David Wu on Bond. This is a global forum devoted to promoting fact-based debates. David previously worked as the global head of FX and rates over at Bank of America. David, good morning to you. The bond market is debating fiscal largesse and soft landing. You're looking at the political outcomes. The Bloomberg poll this morning says there's a dead heat in the swing states. You're pretty convinced that Trump is going to take the White House. Why? And what's your betting on that?
Yeah, I mean, thanks for having me. Yeah, I think there's a 75% chance I think Trump is going to win, on November 5th. And let me tell you why. First of all, as we all know, pollsters have gotten the last 2 elections completely wrong. In fact, polling errors were even bigger in 2020 compared to 2016. Now, this is the reason why I tend to focus only on pollsters that have a good track record. If you look at the last 2 presidential elections, Trafalgar Group and Insider Advantage have by far the best track record in terms of being more predictive, especially among the battleground states. And both of these pollsters currently have Trump ahead by about 2 points in North Carolina, and Georgia, Pennsylvania, and Michigan. Of course, Trump, if he wins only 3 of these 4 states, basically the election is a lock. But there's also more to that. If you think about the key demographic groups, Trump is doing a lot better among blacks and Latinos compared to how you was basically did in 2020. Interesting. There are a lot of black people in Georgia, and there are a lot of Latinos in Arizona. Moreover, Trump actually is currently leading Harris by 13 points among white females without a college degree. And guess what? There are a lot of those in Michigan and Pennsylvania. So whether you look at momentum, you look at the most accurate pollsters, you're looking at the demographic groups, all of which would suggest that the momentum is very much with Trump this time around.
David, what about down ballot Senate and congressional races? Because for this market, that matters hugely, inability to get policy through. Do you want to price in at this moment the most extreme, the most whatever have you of Trump policies and assume that the red sweep is also going to happen?
Yeah. I think the red sweep is likely to happen. I give it a 50% chance. You know, I think the Senate is an easy call, right? I mean, the Republicans are leading in West Virginia, in Montana. If they keep Texas, Cruz keep his seats, you know, they have 51 seats in the Senate, which will be enough, by the way, to confirm all the Trump appointees once, you know, basically his administration's up and running. Now, I think the House race is less clear because House race, you know, is all over the place, honestly. But I would say this, which is that you have to go back to 1984 to see a situation where the Republicans won the presidency and the Senate and lost the House. So I think from that point of view, what I'm saying is that the probability, if Trump wins, the Republicans win the Senate and the Republicans somehow lose the House, I don't quite believe that. Now, so from that point of view, I think the sweep is a very good chance. Now, as you said, right now the market is starting to get into this sweep basically mode, and this is why, you know, we've seen inflation break-evens going up, gold prices going up over the last 3 weeks. I mean, all the inflation-linked assets are going through the roof because people think Trump and things sweep is going to lead to higher inflation. The only question I would basically disagree with, I don't think that should be taken for granted.
Look, the thesis that you put forward there, David, is in part reflected in these markets, partly by fiscal largesse and partly by the risk of stagflation and a Fed that would have to either pause or reverse. Can you combine that narrative? Let's deal with the bond market first of all. Two's dropped 47 basis points since the jumbo cut. 2016, yields spiked by 100 basis points. So we've traveled a great deal of angst so far in the dollar, in the bonds, and in the gold market.
Exactly. Now, I would say this is what's going on. I think it's a common, you know, obviously, I thought it was a big mistake for the Fed to have cut 50. So I think what the market is doing, has been doing the last few weeks, simply unwinding, you know, that mistake, so to speak. And I think even the Fed probably would admit if they knew what they know now, they probably would have done 25. But be that as it may. But I think, you know, the biggest part of the move in the bond market and rates is the inflation break even as opposed to real yields. What it's telling me is that the market is thinking that now Trump is more likely than they thought basically a month ago, and that is driving up inflation expectation because, as you said, people are thinking fiscal largesse. I happen to disagree with that view, or at least I don't think you can take that for granted. The bottom line is this, to me, is very simple, okay? I don't care if it's Harris or Trump. Both of them are going to be facing a deficit $2 trillion, which means that both presidential candidates will be very, very seriously fiscally constrained. In other words, in my view, Trump will have to look elsewhere if he wants to somehow basically, you know, grow the economy. And there are two things that they've already promised, both of which is actually disinflationary. If you look at what Scott Bessent says, number one, they're going to do massive deregulations, okay? Number two, they're going to massively increase oil production by 3 million barrels per day. That will basically bring up to 16 million barrels per day. Let me tell you that if that happens, oil price is going to be in the low 40s.
Hey, David, I got to jump in because I want to squeeze this in here because we don't have much time left with you. You write that there's a 75% chance that Israel might counterattack Iran before the next U.S. election. Only about a minute here, David. But how would that shape and change everything you just told us?
Yeah, I'm sitting here in Israel. I mean, if you think about what happens, you know, like, you know, if Israel attacks Iran, I'm telling you, you're looking at an all-out war. That means lower stocks, lower rates, you know, and higher energy price, which are exactly the opposite of the so-called Trump trades at the moment. So I would argue that over the next week, there may be even better opportunities, better levels to enter into Trump trades. I would be holding my breath.
Okay, David, we appreciate your time this morning. That is David Wu, CEO of David Wu Unbound, passionate on the results of this election to come. This is Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's been a brief. I'm Manny Screening alongside Danny Berger here in New York. Tesla is jumping pre-market this morning after a supplies blowout quarter. Earnings were boosted by sales of the Cybertruck, which turned a profit for the first time. Elon Musk also gave an upbeat forecast for next year's numbers.
I do want to give some rough estimate, which is I think it's 20 to 30% vehicle growth next year. Notwithstanding negative external events.
Promises and timelines, things to be discussed from Elon Musk. Let's bring in our global automotive editor, Craig Tudell. Craig, you look at these numbers, Cybertruck profit for the first time, but it's what he promised to deliver in terms of cars next year that really were standout. We're up 12%, $80 billion. Is this the worst behind Tesla now?
That was at least Musk's story, and I think that's what investors clearly wanted and needed to hear in order to bid the stock back up. I think it is kind of incredible that we've gone from the stock being so driven by things like robo-taxis, things that have been perceived as probably further off, despite what Musk has been telling us for years and years. To now, looking more at the fundamentals. And I think if you do look at the fundamentals for this quarter, they were much better than expected, but this is not a company that is growing at the top line the way we were accustomed to for a long time. So this was really achieved, I think, primarily by a sort of well-run, well-operated quarter that they benefited from lower costs and sort of scaling up their newest product, the Cybertruck.
Tesla up almost 11% in the pre-market trade. Some people agree with you, Craig. Bloomberg's Craig Trudell. Let's now bring in Tom Narayan, global autos analyst for RBC Capital Markets. Tom raised his price target for Tesla to $249 following the report with an outperform rating on the stock. So, Tom, you also saw some things that you liked. How surprised were you of how strong of a quarter it was?
I was very surprised. I thought we'd have a really good energy storage and regulatory credit number. What I was surprised by is the auto fundamentals. The automotive gross margin X credits was 17.1%. Consensus was expecting 14.5%. I was expecting 13.5%. And the reason why we all thought it would be so low is because they cut pricing so much to get that big volume number. I was like 8-9% pricing cuts. The reason why they got that is, as your colleague mentioned, better cost controls. There were some logistics and freight they called out, which may not benefit again next quarter. But then they said the FSD launch helped too. But underlying car costs were better. I do think some folks who are worried about Tesla now will think, okay, they got that right. Now we can actually look at those pet projects, so to speak, robotaxis, FSD, energy storage, Optimus, so folks are more comfortable looking at those bigger picture themes.
Well, this is where maybe they'll give him a little bit more length, whether it's robotaxi or Optimus. But when you look at this story, he didn't give any detail on the new, cheaper model, offered no details on CY25, no details on FSD, and no details on the plans for Optimus. So it's, again, high on promise, low on actual delivery and timelines, if there is a negative to be found in this.
Yeah, and I mean, this is par for the course, right? We're not going to get, heavy details on, robotaxi in my model. It's a 2040 event, right? Optimus, I think we'll get more details coming. That may actually be a closer event than even robotaxis. We did get some high-level commentary on FSD on safety. Autopilot, we know, is 10 times safer than regular cars, so we can surmise that FSD is safer too. So we got some high-level comments. I think we'll get more in time. But the bigger picture here is the car business has been kind of, is now not a concern to some folks. And we can get growth next year. I have 13% growth next year on volumes. Because of this low-priced car, they have said in the past that it'll be used on existing facilities and we'll get a low-priced car. The reason why they don't want to talk so much about it is what they call the Osborne effect, which is if everybody knows they're going to come out with a lower-priced car next year, are we going to buy the current ones, right? So I think that's part of what's going on. We will get a lower-priced car next year, and that should boost demand.
Tom, I'm sure one of the stranger twists in your job is now your need to talk about politics along with Tesla. Elon Musk on the call was asked about national approval for autonomous vehicles. Let's just take a listen to his answer.
It should be possible too. Congress, if you're listening, let's get a federal AV. There should be a federal approval process for autonomous vehicles. It really needs to be like a national approval is important. If there's a Department of Government Efficiency, I'll try to help make that happen. And it's for everyone, not just Tesla, obviously.
Of course, a Department of Government Efficiency would be what he would run under Trump administration. Tom, to what do you understand is positive or negative if it is Trump as the next president? You have Elon Musk's ability to do this thing, but as Jordan once said, Republicans buy sneakers too. Democrats also buy EVs. How do you understand the negativity and positivity that might come with the Trump presidency?
Yeah, I mean, what we've said is basically if you look at Tesla as a stock, it benefits from the IRA, Inflation Reduction Act, which has credits for EVs, which is a Biden, bill that's passed its law now. I don't think it's going anywhere. Also, Tesla's wanted to produce in Mexico. We know that Trump wants to put tariffs there. So at face value, it would appear that, it'd be more, Tesla would benefit more from a Democratic administration. But then we have to look at kind of the strategy here. If you already know you're going to get all those things with the Democratic administration, perhaps it could make sense to hedge and get favor with the Trump presidency in case Trump wins. So maybe that's what's going on here. I don't know. But it would appear if you're Tesla, you would want a Democratic regime to win. On regulating robotaxis, I'm not entirely sure why Trump administration would deregulate that. It's a state-by-state system is what we have. And I think Trump has said in the past in the press that he's not necessarily a big supporter of AVs, autonomous vehicles. So I'm not entirely sure if a Trump administration would be better for deregulating robotaxi.
Well, there's certainly a wonderful stat. What Democrats are 4.5 times more likely to buy an EV. So maybe with Elon in government, the power of branding can convert the Republicans across to EV. Can we square off where we are with China? Obviously, huge competition. It looks like these price cuts are a thing of 2023 or sort of fading memory of 2024. When you look at the China policy of financing and incentive, how does that set up internal competition to Tesla? Where are we in terms of the China narrative?
Yeah, I mean, this past quarter, we've had intense competition, and Tesla actually did very well in China. I think it's the whole market is actually doing very well with EVs. The losers in China are the ICE companies, right? Look at what happened at GM earlier in the week. And so I actually think it's a rising tide lifts all boats. If you're selling EVs, you're going to do well in China despite the competition. Make no mistake, Tesla's going to have to cut pricing next year. That's in my model. It's in most models. But what we saw in the Q3 results is despite price cutting, they were able to sell cars profitably. So I actually think they'll be fine here next year in China. It will be competitive, but EV sales are doing very well.
Okay, well, the stock, they love it this morning. We're up at 10.86% and change. Tom, thank you very much. Tom Narayan there at RBC. There are other earnings coming down the pike this morning from the airlines. American Airlines, Southwest Airlines, both will report before the market open. And investors look to their efforts to win back the corporate traveler. Guy Johnson is with us. Guy, I mean, this is a battle for the front of the bus, so to speak. There's a lot going on in this space. Just talk us through, is revenge tourism still there? Is the high-end business class being filled by us or by the corporates?
Corporate travel has never come back as strongly as we anticipated that it would post-pandemic, Manus. I don't think that's a huge surprise to anybody. I think American, which has its numbers out at 8:30 Eastern this morning, could be really interesting. Remember, American tried to basically cut out the middleman, and that didn't work out so well. And as a result of which, it's basically having to rebuild its corporate relationships, particularly in key markets, and it has struggled to do so. Its margin is lagging. It needs to get that to be picked back up again. It is lagging quite considerably, airlines like Delta. So it'll be interesting to see exactly what that margin story looks like at American a little bit later on. Southwest is going to be interesting as well. We'll see what its numbers look like. Remember, it's the bottom end of the market where we're starting to see some weakness coming in right now. And Southwest certainly is in line for maybe some pressure to come there. But Southwest also has had management issues as well. And you've got Elliott, Paul Singer, certainly champing a bit the bit to see some changes. Maybe we'll get a deal announced today. There's certainly indications that we could see maybe a resolution to the proxy fight that Paul Singer has pushed through. He wants 8 seats on Southwest board. Looks like we're going to end up maybe with 3, but it is unclear at this point as what's going to happen with the CEO, Bob Jordan, and his predecessor, Gary Kelly, who is now the chairman. So 2 really interesting airline stocks out of the US a little bit later on today. And remember, Southwest, huge Boeing customer as well. It is going to be maybe suffering as a result of what is happening with the ongoing strike up in Seattle.
To that point, strike still ongoing, Guy. Despite a vote yesterday, they didn't manage to hammer out a deal. How far apart are the two sides still?
It's really hard to tell, Danny. Remember, this is a 35% increase in the pay packet that has been presented by Boeing to its unions. The unions have now rejected that. The sticking point seems to be the pension, the defined benefit pension that union workers would like to see reintroduced. They say that that was one of the critical grievances going into this process. And while there's been some additions made to the 401k program by management, they still haven't reinstated that. So the 35% pay bump is simply not enough. They want to see that happening, but that is a big move for Boeing to make. Are they prepared to do that? Are they prepared to do that quickly? While the number of people voting against this deal has dropped from 94% to 64%, the two sides are still quite far apart, and this pension issue could be quite intractable. So we'll watch and we'll see. But Boeing, ongoing problems. Kelly Ortberg was on the call yesterday. He's definitely done his research, but he's got some huge problems in front of him right now, guys.
Guy, thank you for the update. That is Bloomberg's Guy Johnson. Coming up, we're going to set you up for your trading day. More earnings on the docket. That's next on your Bloomberg Brief.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Thursday. We're going to get earnings from UPS, Honeywell, American Airlines, and Southwest Airlines. All of that before the bell. Then some data today, 8:30 a.m. Eastern jobless claims, PMIs at 9:45, new home sales at 10 a.m. And then the Treasury will sell $24 billion of 5-year tips this afternoon after a weak 20-year auction yesterday. Manus.
Yeah, given the inflation outlook, maybe that will be gobbled up quite easily. Nvidia is up over 1%. Tough day yesterday. Jensen Huang struck a partnership with Asia's richest man, Mukesh Ambani, to build out the AI infrastructure. So we're turning it around from yesterday. IBM extends its post-earnings decline. Weak consulting sales weighing on the results, down 4.8%. And Uber down 1.88%. The shares slide alongside Lyft on Tesla's plans for ride-hailing in 2025. Musk said that the services will roll out in Texas and in California next year, pending regulatory approvals. And of course, he talked a lot about regulation on that call yesterday evening, Danny, didn't he?
Yeah, he did. And of course, what you're seeing there in Uber stands in contrast to what Tesla is doing this morning, up nearly 11%. Is that also what's saving Nvidia, Manus? It was such an ugly day yesterday for the Mag 7, falling 2.15%.
Yeah, it certainly was an ugly day, but the sand got taken out of the gearboxes by Elon.
Great pun. Great pun.
That's
what a note to end it on.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There is an extraordinary uncertainty tax on this economy.
You're not yet back at that extreme optimism, sort of peak euphoria territory. And really all it does is make the market more vulnerable to any kind of negative catalyst.
The trend remains a disinflationary one and therefore supports a cutting cycle.
It's the fundamentals of the U.S. economy and earnings and interest rates. That's what we focus on.
The U.S. economy has once again proven more resilient than fears had suggested.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 3-day losing streak on the S&P 500. A 3-day losing streak, which is the longest losing streak going back to early September. Equity seeing just a little bit of relief this morning. Equity futures up by 0.4% on the S&P. On the NASDAQ 100, we're up by 0.75%. Two stocks to watch: Tesla and Boeing. Let's kick it off with Tesla, knocking it out of the park. A blowout quarter and some huge promises from Elon Musk, promising 20 to 30% delivery growth through next year. That stock, AMH, is up 11%.
Dan Ives, who'll be joining us, says it was an Aaron Judge-like margin performance. I loved that note. Morningstar analyst. Prices are stabilizing and unit costs are coming down. For Tesla, it feels like this moment potentially is a change of direction. They had a tough few quarters behind them. Right now, they beat estimates, and they're talking about slight growth in the future. We're so fascinating. Every day we talk about their slowdown in China. For Tesla, that's where their growth is.
That's a really tough market for them, too. If you compare and contrast what we've seen from some of the US players in the last week, Tesla, GM, the numbers are okay. Compare and contrast that to Europe. We've had profit downgrades, cuts to the outlook over at Stellantis, VW, BMW. Take your pick. Europe's a mess.
Absolutely. But with Tesla, China demand, quote, continues to outperform U.S. and Europe by a factor of 3 for EVs. But all of this is more subsidies to stimulate some of those sales that's going on in China. Also, what's going on in China? Bloomberg has a scoop that actually they're telling some of these Chinese automakers to slow down, hit pause when it comes to investment in the European Union because they're still negotiating these tariffs.
Which takes us to another mess. Boeing, down in the pre-market by 2%. I didn't expect to be talking about this morning. I thought we'd strike a deal yesterday afternoon. We didn't. The strike continues. Factory workers rejecting a new labor contract, which would have increased their wages by 35% over 4 years.
Also would have gotten a bonus. It also had some retirement benefits, but not enough, it seems like. That seems like the real crux right now. Not enough that these workers say we're ready to go back. You have to think they haven't been getting paid. They also have not had access to health care, which is why so many people thought this deal was going to get it done. Yesterday in the earnings, what did we hear from all the analysts? They can put all of this behind them once that contract gets done. Now these workers are staying on the picket line.
Sheila Kahyaoglu, a little bit later on this program, about 30 minutes away. Look out for that conversation. That stock is negative by 0.2%, or rather 2%. For the broader market, we look like this on the S&P 500. Equity futures firmer on the S&P up by 0.4%. In the bond market, a 3-day slide, replaced by a little bit of a bounce. Yields lower by 5 basis points, 4, 19, 18. More on the euro a little bit later. The PMIs out of France not great at all. The composite, a little bit better in certain places. Euro dollar at the moment, 107.98. Coming up on the program, we'll catch up with George Concalves of MUFG as earnings season heats up, Douglas Redeker of International Capital Strategies on the IMF's global growth outlook, and Dan Ives of Wedbush on Tesla's blowout quarter. We begin this hour with the S&P 500 looking to snap a three-day losing streak. Equities getting a boost on Tesla. Kicked off Mag 7 earnings with a solid report, posting its biggest quarterly profit in more than a year. Joining us now to discuss is George Concalves of MUFG. George, welcome to the program. The earnings, let's take the banks for instance. The banks say the economy is okay. Retail sales just last week said the economy was better than okay. I want to go back to September. You absolutely nailed the 50 basis point reduction at the Federal Reserve. How have your thoughts on the next move from the Federal Reserve evolved over the last few months as you go through the earnings from corporate America and you look at this economic data?
Yeah, thanks for having me back. And look, the outlook for rates here, I think, do matter. And you know, we're at a really important crossroads with the election that's coming up and a number of key macro events into the end of next week, as well as all throughout the first few weeks of November. So I think we get these macro events every so often. We had it in the last week of July through August. This one could, in theory, it should be actually much larger considering the implications around the election and the Fed and an NFP all kind of coalescing into that short time frame. Look, I think the Fed has to still cut rates, regardless of who ends up, and become the next president. But we're going to see, much lower rates because the Fed is still restrictive, and we're still challenged with calibrating the fiscal policy as a substitute for Fed policy. And I think those days are gone unless we get, some sort of reason to go spend and really increase fiscal balances even further. I think that the Fed policy still is important to the economy.
So, George, with the rate move in mind, with the developments in the bond market of the last few days in mind, are you suggesting that absent a red sweep, a GOP sweep in about 2 weeks' time, this market's kind of hitting its limit on bond yields right now?
So, absent a red sweep, yes, I think so. I think so. I mean, we're really concerned about the potential for much larger tax cuts from a red sweep, which would that entail that we shall see. But it would really come down to I think 4.5 on the 10-year note will start to matter for other markets, not just for the bond market. We got a little bit of evidence yesterday, given equities finally having a bigger move to the downside. So I do think 425 on absent a red sweep is getting pretty close to the high end if we don't get a red sweep.
So, George, where are they going to go if we do get that red sweep? This isn't the base case for a lot of people, but people are starting to potentially price in that this could happen. What if it actually does?
Well, and then this is why everyone's harking back to the 2016 playbook, and where we saw a pretty big intraday swing when Donald Trump won the presidency back then. We had rates moving 30, 40 basis points in the overnight sessions, pretty big moves that culminated with 3 days of 65 or more higher in interest rates. I think that's what the hedging that's probably going on right now is for that downside risks for much larger rate moves. But because we've seen this before, I think a lot of it's now being priced in, and that's why we're thinking 25, 30 basis points further from here, even with the red sweep.
George, when you look at the policy proposals, though, on the Democratic side, they're still talking a lot about fiscal spending. They've kept the tariffs, some of those that Trump put in place during his first term. Why is it a red sweep that's driving this and not even people considering the fact that this could also be a scenario under the Democrats?
Look, I think that's a very fair point. I mean, I think either majority rule will likely result in additional spending, and that could be in likely debt finance type spending or tax cuts that are financed by debt. Either way, you're going to see a rise in overall debt outstanding, and this is where it starts to really matter. I think the next president, whoever that may be, and next government will have to deal with fiscal sustainability, and interest rates will matter for the government, not just for the economy. And so as we get towards 5% or higher, it's going to really start to challenge the ability to spend like we have been.
George, you said this Federal Reserve is still restrictive. They'd carry on cutting interest rates. What tells you that they're still restrictive? And to use their phrase, sufficiently restrictive, what's the tell for you?
Look, I think that the fact we're still not seeing robust bank lending, that most of the bank lending is to non-bank financials, corporations, private credit, And the fact that, we're if you look at it in real terms, bank lending is actually negative if you actually take out security markets improvements in their portfolio. So, banks with an inverted curve cannot really operate for this much longer, especially the regional banks. And so I do think that there's restrictions, and they're being restricted by keeping rates this high and the curve inverted.
But as you know, George, financial conditions elsewhere are super easy. Equity markets have pulled back a bit, but still close to all-time highs. You're super focused on credit and fixed income. Credit spreads incredibly tight. Investment grade, looking at the tightest levels we've seen going back several decades. We've had rates close to 5% now for the best part of 18 months. Unemployment's still very close to 4%, and inflation is just about south of 3%. George, some people might look at that and say, well, actually, maybe this neutral rate's closer to 4% than it is to 2%.
And even if so, they will still have to cut, right? So I think that's the whole point. The short-term neutral rate could be in the high 3s, low 4s. We don't know, and that could depend on this sort of fiscal calibration that we're all trying to do real time. But as we kind of go through this, we'll realize, is our star really 100 basis points higher from what it was pre-2019 when we have a debt to GDP of over 100%? If you look into all the sort of debt outstanding, at some point the debt outstanding, the interest costs, that will start to kind of reduce growth potential. And I think that will bring down rates overall, and the Fed will have to get down towards 3% again.
Are these arguments to move a little bit more slowly? Or do you think the next 100 basis points is on autopilot when they talk about recalibration? Is that ultimately what they're conveying to the market?
I mean, we think that, look, the November cut, I mean, it would be disruptive not to deliver the cut. And I think it would really require a really large NFP next week, as well as a revision to the September number to the upside, not to the downside. We've been getting more revisions to the downside, as you know. So it would have to be a really strong NFP for them to skip. And I don't think they would do that anyhow. But the December cut, that could be a skip, especially if there's a red sweep and you see the stock market continue to do well. And if we have early indications that early shopping season is doing well into December, then the December cut could be a skip. It's not our base case yet. And that could be a time where they actually adjust QT as well as a substitute for not cutting.
George, you're talking about the fact that the fixed income market keeps being swung around based off narrative shifts in politics. What if the Fed meets on November 7th and they do not have the results of the U.S. presidential election?
Even more reason to cut and to keep it consistent.
George, we'll leave it there. It's good to catch up, buddy, as always. George Goncalves there of MUFG, who absolutely nailed that 50 basis point reduction back on September 18th. Just want to get you up to speed on some numbers coming out of UPS. UPS EPS coming in at 176, the estimate 163. On revenue, a little bit of an upside surprise, 22.2 billion, the estimate 22.16. In the pre-market, the stock doing nicely. Last time I looked, up something like 5%, up 5.8%. In the pre-market. With an update on earnings and news elsewhere, let's get you your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. On those Tesla earnings, shares up more than 11% pre-market. It reported its biggest quarterly profit in more than a year. The EV maker also reported that Cybertrucks have turned a profit for the first time and laid out ambitious plans for the future. Tesla's chief executive, Elon Musk, shared the company's aim to officially roll out ride-sharing in Texas and California next year. He promised to make Tesla the most valuable company in the world. Barclays shares, those are rising in the London trade, 3.74%, touching their highest level in 9 years. It posted a surprise increase in fixed income trading. Revenue topped analyst estimates. Executives are now delivering on the lofty promises that they made earlier this year in hopes to boost the bank's lagging returns. Meanwhile, Boeing shares falling in the pre-market this morning. Factory workers rejected a new labor contract offer. Workers will remain on strike, and that is a fresh blow to the struggling plane maker. About 64% of union members who cast ballots on Wednesday voted against that deal. The contract would have raised their wages by 35% over 4 years. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, downside risk dominating the outlook.
We see the risks of adding up, and we see them to the downside. Right now, markets are still very buoyant. Valuations are fairly high. This is risk on. That could change.
The IMF's annual meeting down in Washington, D.C. Bramo on the other side of this commercial break. From New York City this morning, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I'm doing this for Lisa, the beige book from the Federal Reserve yesterday afternoon. Check this out. Just compare and contrast what we're seeing in the economic data to this kind of commentary from the Federal Reserve. Economic activity little changed in nearly all districts since early September, though 2 districts reported modest growth. Retail sales, big upside surprise. Things seem okay, the earnings, the outlook, pretty decent from the financials over the last week, and then a pretty downbeat beige book from the Federal Reserve. We'll come back to that a little bit later. Equity futures on the S&P 500 up by 0.4%. You've got a bounce back from 3 days of losses. In the bond market, Treasuries bounced too. Yields are lower by 5 basis points. The 10-year 4.1918. Under surveillance this morning, downside risk dominating the outlook.
We see the risks of adding up, and we see them to the downside. And among those risks, we see geopolitical risks, the Middle East, oil prices, commodity prices, fragmentation, trade wars, tariffs. This is certainly a risk that is on the horizon. Right now, markets are still very buoyant. Valuations are fairly high. This is risk on. That could change.
Here's the latest. The risk to the downside still building. The IMF cutting its global growth outlook for next year as the list of reasons to worry continues to grow. Speaking of reasons to worry, Lisa has more. She joins us now from the IMF headquarters in Washington, D.C. Bramo, looking forward to your coverage today. What tops the agenda?
Well, let's just start with the idea of the rise of protectionism, and this is something that we're going to be talking about with our guest here. A question of what does that mean? Does this mean the concern about, say, China and what's going on there? Or does this mean the concern about the U.S. and Donald Trump coming back to office and what that could mean with respect to the gates going up in the United States? It's something different for everybody. And yet there is a lot under the surface bubbling up in terms of existential concern about what this alliance means, about what free trade means, about what kind of economic scenario we will have under different scenarios that could possibly come to pass on a policy level. I'm going to be speaking with both the Lebanese finance minister as well as the head of Israel Central Bank. We're going to be speaking about both what it means to have an economy in a war zone as well as the fundamental question of the divide between Europe and the U.S. with the head of the German Central Bank at a time where there's so many questions about how they really revive their economy that has traditionally really relied on the auto manufacturing sector.
Lisa, how much are you hearing on the sidelines that these individuals outside the United States are concerned about a more protectionist U.S. regardless of who gets into the White House?
To some degree, that is a base case. It does seem like there is a feeling that one candidate will be regime change and one candidate will not. And that is the difference, the sort of question of how much you fundamentally threatening to undermine the concept of who allies are and who they are not, and really raise the question of the need for partnership versus something that seems more predictable, more of a continuation of the old order. And that seems to be more of the tone, even if tariffs are here no matter what, even if some of the trade policies that were here under Donald Trump are the same that we see continued under Joe Biden. There is a feeling of different tone, and it seems like that is being painted in more stark contrast on both sides. John, Anne-Marie, I do want to bring in somebody who is much better versed in this, I will say. And I am very pleased to say that Doug Redeker, a former board member of the IMF, as well as the managing director and managing partner and founder of International Capital Strategies. So how much are you seeing this sort of dominate the discussion right now, the idea of the potential outcomes really determining of this election, determining vastly different economic scenarios?
Well, there's the public face and the back room or the off the side face. Publicly, the IMF is being very cautious to talk about protectionism, to talk about downside risks, to talk about global uncertainty. Behind the scenes, that just means we're really worried about the U.S. election. It's not really for the IMF or for a lot of other institutions to overtly say we're scared to death of the outcome of the election, because that's not politically savvy to do. But behind the scenes, and very tangentially behind the scenes, because it's really in the front of the stage, the election is all that people are talking about.
Well, to Anne-Marie's question, how much are we looking at a scenario that is very different under a potential Kamala Harris versus Donald Trump, even though tariffs have been continued under the Biden regime?
Yeah, so I think protectionism and tariffs and something called industrial policy as opposed to fair or free trade, that's now the new norm. And that's unfortunate, but that's being built into everybody's models, and they're kind of dealing with it in a traditional macroeconomic IMF-y kind of way. But the difference between Trump and Harris is to upend the status quo, as you mentioned, versus we can predict this. And that's a big deal. It's a big deal. You heard Pierre Olivier yesterday at the WEO. You've heard everybody else talking about this in somewhat, softly terms. They talk about a downside risk. Well, the downside risk is huge. And it's huge because it basically upends all of the starting points for their analysis. If you impose 10%, 20% tariffs, it is hard for the IMF, even though they gave it a good college try, to actually model what the impacts of that would be, because the IMF actually said, we can make a dent in this, we can make some assumptions on 10% this and extending the Trump tax cuts for 10 years for that, but really what they're saying is tit for tat means this could explode into a very uncertain downward scenario, and we don't want to actually explicitly talk about that, but behind the scenes we're scared to death.
I feel like there's always an elephant in the room with the IMF. I feel like at least over the past couple of years, that's how it's been. A year and a half ago, I remember the elephant in the room was China. You know, last in Marrakesh, it was the war in Israel and the attacks on Israel. A question about China. It is a very different scenario this time around, where there's a meeting being held in Russia of the BRICS summit, where a lot of the leaders are from both China and Russia, and they are not here. How does this sort of parallel really represent the new state of affairs?
Well, I'm glad you brought that up, because I think it's both the BRICS versus the West, the IMF representing the Bretton Woods institutions established by the, quote, West, and the BRICS scheduling the same week. That's not a coincidence. But then specific to China, China really used to play a big role at the IMF meetings, because in particular, the PBOC would send the governor, Governor Zhou, Governor Yi, who were very well-respected international players, and they really represented that relationship building, knowledge sharing between the international economic policy community and the Chinese PBOC leadership. They are not here this year. That's a big deal. They're in Kazan. They're at the BRICS summit, or the successors to those two governors. They're not here. That doesn't mean that the deputy minister and the deputy governor are not credible interlocutors, but they're really not at the same level. And that, to me, suggests that China is not shrugging its shoulders and walking away from the IMF, but that there's a real sense that the international financial institutions represented by the IMF at the top of the pyramid are no longer getting that buy-in that they really need from China, and that's troubling to me.
So as a former board member of the IMF, at what point does the IMF benefit for coming out and saying, look, this is a multipolar world, this is the alliance that we're representing, what free trade means in our universe is trade agreements between these nations, and we have to really retreat from that initial sort of we are the world vision?
I don't know if they want to retreat from we are the world. I mean, it's a very delicate position that the economics department and the financial stability report and other flagship reports are coming out with this week. So I'm not sure they're going to retreat from that, but they are trying to draw that line between what is good for the global economy and the world that we're actually confronted with. And those two are divergent because, as we started with, protectionism is the norm. I thought Christine Lagarde in Bloomberg earlier this week, when she was asked what is your favorite word? She gave 2 words. She said fair trade. And I tipped my hat to her because nobody's saying that anymore. You heard Jake Sullivan yesterday at Brookings give a speech that was a year and a half after his speech last year, in which he took a very protectionist bent then. He was a little less protectionist this time. So I guess my view on the Kamala Harris, you didn't ask about it, but let me weigh in on this. If Harris does get elected, while I don't see her just embracing free trade, I do think that there's some IMF-inspired, this actually is better for the world and better for the U.S. if you start to see trade as maybe not, a bad word. I'm hoping that that actually starts to percolate through these meetings and through the U.S. election. I'm skeptical, but I'm hopeful.
How much are people fundamentally speaking in different terms when you speak with them this time around because of potential regime shifts that could come on the back of whatever happens?
I think everybody is just hunkering down. I think in a 50-50 election scenario, with the election being such an elephant in the room, that basically everybody is just saying publicly, well, we don't know. We don't know. And they don't know. And none of us know. And that's actually just the elephant in the room right now is not just the election, it's the uncertainty about the election. And no matter who you talk to, if they tell you they know, they don't know.
Doug Rediker, thank you so much for being with us, for waking up early, and for being here in Washington, D.C. at the IMF headquarters. John and Marie, back to you.
Hey, Lisa, thank you. Looking forward to the coverage a little bit later this hour. Lisa sitting down with the South African Central Bank Governor, Lesetja Kganyago. Look out for that. The outlook for 2025. What's it worth without knowing the outcome of the election in 2 weeks' time?
Well, what Doug Rediker is saying there is now a normal basis when you look at American policy that they are more protectionist. But the issue is, how far does that protectionist run? And with one candidate, it's much deeper. He's talking about 10% tariff ring around the United States, 60% when it comes to China. That is a lot different than what the Harris campaign would explain when they view tariffs as targeted. They want it to be narrow. They don't want to use other things like export controls. It's very difficult if you're a European country sitting in the middle of China and the United States, you're not sure what the policy is going to look like.
Your outlook could change a lot based on what happens in this country in the next month. Up next on this program, Dan Ives of Wedbush has Tesla reports its biggest quarterly profit in more than a year. That stock is up more than 11%. From New York, this is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that, have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're looking for a bounce here in the equity market. Equity futures on the S&P 500 shaping up as follows. Firmer by, let's call it 0.5%. Yesterday, the biggest one-day loss. Going back about a month across the board here. 3-day slide on the S&P. On the Nasdaq, we're bouncing back by 0.8%. Mild losses over the last few days. Don't want to overdo it. They picked up yesterday. Just this consistent water torture coming from the bond market. The drip, drip, drip of high yields. Check out the bond market. 2-year, 10-year, 30-year. These are the scores right now on a 2-year. We're down 3 basis points. Some relief. A rally, if you will. 4.04% on a 10-year, a break of 420 to the downside, going into jobless claims a little bit later, 418.99. Yields are lower by 5 basis points. We've had a big spike. Since the Federal Reserve reduced interest rates by 50 basis points, we've had a move of more than 50 basis points in the wrong direction for a lot of you. So on a 10-year, much higher yields, and we've been trying to break it down on this program. Is it the economic data or the politics? And everyone's got a very different view. This was Steve Englander of Standard Chartered. Most of the October move in U.S. yields seemed due to NFP rather than Trump. A further market move on a Trump win may depend on the Republican sweep in Congress as well as winning the White House. We've heard that a few times this morning. Some back and forth. Is it the data or the politics?
Well, I'll go back to Torsten Slok, and he was talking about the fact that it was that NFP, and it's the fact that term premium has been pricing in over the course of the past month outside of what's going on in the election. But then you look at George Conclavis, and what is he saying? He's saying that if there's a Republican sweep, potentially yields can go even a little bit higher, but he says that's the max. So potentially after the election, depending on what happens, we actually could see those yields come down.
That's the US side of the trade. Let's talk about the European side of the trade. Euro dollar, capturing that in foreign exchange. Break into 107 over the last few days. 108 right now, just about holding on, up 0.2%. The data not great. Out of France, awful. For the composite, for the Eurozone, manufacturing 45.9. Basically on its knees. The only good news is that the survey was 45.1 and the previous number was 45. So that's an upside surprise on manufacturing. Services at 51 and the composite 49.7 against an estimate of 49.7. A month ago, we were talking about data dependency, taking things by meeting over at the ECB, and then all of a sudden, reality check. Just slapped round the face by the economic data in Europe, and the economic data in Europe has not been great at all. And for the first time, you're having a real conversation now about the prospect of 50 basis point reductions at the European Central Bank.
And when you hear from ECB officials, what they say is, well, Christine Lagarde, what she said, the president, she's talking about the fact that it is a trend we are going to be cutting. She didn't want to get into the 25 or 50 debate. But when you see data like this and the fact that inflation is coming down closer to their target and the growth prospects look dim, and it could be even worse after the November 5th election, depending on if the tariffs go up and Europe's going to be stuck between a very hard place between China and the United States, then people are starting to say maybe 50 is the right move.
Lisa sitting down with the Bundesbank president, the German central bank governor, a little bit later this morning, 8:45 Eastern time. Look out for that. Under surveillance this morning, Japan's finance minister delivering a warning over the yen's rapid moves, saying he's raising the level of urgency for monitoring currency moves after the yen hit an almost 3-month low against the US dollar. Dollar yen still above 150.
So he's also talking about watching for speculative trading. How are you not going to be speculating in the dollar yen trade? Why? 2 big elections coming up. It's not just the United States that's going to be pushing the dollar yen trade. Also, this Sunday, The Japanese economy, that country has an election as well. So they are really stuck between two of these big hurdles they have to clear in the political space.
You mentioned the elections. Let's talk about the latest polling coming out of Bloomberg. Bloomberg News and Morning Consult finding Trump and Harris are locked in a dead heat with Election Day less than 2 weeks away. The candidates statistically tied in each of the 7 swing states with 49% support among likely voters.
Absolute knife's edge. What I would say is if you go back to September, we have been doing this poll for 1 year. Harris was leading among likely voters in the swing states by 3 percentage points. So now you see them in a dead heat. So she's lost a little bit of that momentum and Trump has caught up based on the previous month. Now you look at the issues. If you have looked at our polling throughout the last 12 months, what you will see is that the economy is top and center. No other issue holds a candle. No other issue comes close. And when it comes to the economy, although she's been able to narrow that gap, it was really bad for the Democrats when Biden was top of the ticket in early July in our poll. Trump still has the advantage when it comes to the trust factor.
Super, finely balanced going into the election day a few weeks away. Let's squeeze in some luxury. Hermes sales rising in the third quarter. The company's seeing resilient demand for its pricey handbags, even amid a broader luxury slowdown. Speaking of slowdowns, over at Gucci, Kering reporting small positives, but warning its annual profit will fall to the lowest level since 2016. Look, we're bouncing back because the bar's incredibly low over at Kering, but Gucci's the problem child, and it's still a massive problem. And the numbers in China speak to the numbers we've seen elsewhere from the luxury players. Really not good.
So when it comes to Hermes, they're this outlier. They're able to withstand this downtrend when it comes to China. They are the exception. They are not the rule when it comes to luxury space. And then you look at Kering overall. Okay, so they're slowing down in China like everyone else is for the most part besides Hermes, but Kering has a problem child, as you said, and that's Gucci. And Gucci is the standout. Gucci does well, Kering does well. Gucci not doing well, Kering's not doing well. It does feel like when you hear from executives at Kering, they think the turnaround plan is working with their new designer. They went from loud fashion to a little bit more quiet luxury, but you're not seeing it yet in the numbers.
Gucci's comparable sales slumping 25% in the third quarter from a year earlier. That's the latest for luxury. Let's get you some single names and kick it off with Tesla, delivering better than expected earnings, reporting its biggest quarterly profit in more than a year, and laying out upbeat forecasts for 2025. Dan Ives of Wedbush keeping his outperform rating on the stock, writing, "This is clearly an indication that Musk & Co. is continuing to focus on its profitability side while balancing its plans for the future. The bulls will cheer this quarter in a much-needed margin boost after a choppy 2024. I'm pleased to say that Dan joins us now. Dan, let's get into some of the optimism, shall we? And welcome to the program. Promising 20 to 30% delivery growth next year. Where is 20 to 30% delivery growth coming from?
I think China is really what's going to be driving that. I mean, look, Street Wizard called 10, 11% whisper numbers. So this was much better than anyone thought. That optimism is very important, combined with that margin spike. I mean, this is really an Aaron Judge-like quarter when you put together the margins as well as that delivery outlook. Bulls are going to be happy.
Market agrees with you. Stock is up in double digits in a pre-market, but China's the one where I'm scratching my head just a little bit, Dan. LVMH, Kering, L'Oreal, Starbucks, they're all reporting bad news out of China. Why is Tesla going to be any different?
I think it's really market share gains. I mean, what you're really starting to see is the price cuts have actually subsided. You're starting to see market share gains in China. They just had their best month of China in terms of September ever. That's 40-45% of deliveries. And then you combine that with some signs of strength that I believe will improve in the U.S. as well as Europe. And then the big thing is next year you're going to have a sub $30,000 vehicle. And I think they doubled down on that. And as much as we can talk about autonomous and AI, that is the vision. That is the future. Deliveries, margins, that's the focus. And this is really something where I think the inflection point in the Tesla story began last night.
Dan, can you talk to us about this $30,000 vehicle? Because on the call last night, Elon Musk said a $25,000 EV was, quote, pointless and it would be silly.
Yeah, I mean, in terms of 25K, I think when we talk about what they're going to come out with first half of 2025, that's up $30,000. It's very important from a price point perspective now that they could produce vehicles just so much cheaper than anyone else. I mean, look at their COGS. That continues to come down significantly. That's huge for margins, but also the ability to come out with a car that's essentially cheaper than anyone else out there. And I believe the best EV in the market. And you look at what they're doing, not just in Cybertruck, in Semi, and of course, what they're going to be bringing out when it comes to FSD and autonomous. I think that really multiple growth drivers right now. And right now, look, the New York City cab driver is bearish on Tesla, and I think it sets up for, I think, a stock that will have a 3 in front of it in the next year.
Dan, I know you think this is an Aaron Judge-like performance, but Musk has a history of promising ambitious timelines. How much of what you heard last night do you have to take with a little bit of salt?
Yeah, look, I think you take it with salt, and I think a lot of that's already been factored into the stock. Even if it pushes around, the fact that that margin number hit 200 bips above the street, that's been a huge overhang in the stock in terms of the margins. And then delivery growth, no one expected. Best case was 15%. The fact that he said 20 or 30%, I mean, that is really, it's music to the ears of the bulls. After what's been, as we've talked about on the show, a very, very difficult year. But I believe better days ahead right now. And it just, I think this was a huge quarter, huge step forward for Musk and Tesla.
Dan, you meant to say you take that salt and rub it in the wounds of the bears. That was the line. Dan, it's good to catch up. Dan Ives of Wedbush. Appreciate it. I know you're going to love that line. The stock is up by 11% in the pre-market. Let's turn to Boeing. Some shocking news overnight. 33,000 factory workers remaining on strike after rejecting a new labor contract that would have increased their wages by 35% over 4 years. The Machinists Union saying 64% of its members who cast ballots voted against the agreement. Sheila Kolu of Jefferies joins us now for more. Sheila, welcome back to the program. I was surprised. I assume you were too.
Yeah, I was on the show a few weeks ago saying, 6 to 7 weeks was our marker just based on the first year pay increase. Although it's a 35% pay increase over 4 years, the first year is 12%. So you're wiping out that pay by essentially not getting paid and having no health care over the last 42 days.
Do we know what they're asking for? What do they want?
We're not sure how much of a wage increase they want. They want some sort of defined pension benefit plan, which in the industry has been just globally, that's not a non-starter. But we know what comps are getting. So Textron, a manufacturer in Wichita, just approved their wage increase over the weekend. They gave their workers a 31% wage increase. We've seen American give their flight attendants 33 to 36. So the 35 is pretty standard. Only Air Canada went up to 42%, but obviously Canadian pilots are a slightly different story.
It feels like the pay rise isn't the problem. It feels like it comes down to the retirement benefits. And there was some retirement benefits in this plan, but it's not the defined benefit that the pension had. What more could Boeing give to get this over the finish line?
I have no idea. I mean, I think you just focus on the wages. They have a ratification bonus of $7,000. I think we would take that bonus any day. They also have an AMPP bonus. So the package in general, we find pretty compelling, and so do investors. So the good news is 36% voted for it versus the 6% last time around, but we need 51% to get this approved.
So that's what I was going to say. In September, overwhelmingly, 94% said, no, we do not like this deal. Last night, 64% voted against it. So the one, I guess, silver lining is that it is moving towards the direction of something being ratified. But how much longer do you think this will take?
Yeah, it's not like an earnings miss. When you miss by 15% on this vote, it's much more material than a 15% EPS miss, right? So we don't know how quickly they could even move, right? So 1.5 billion of free cash flow losses per month starting in October for this. So basically October is wiped out, some sort of November is wiped out as well. And you're also hedging your suppliers. So it's putting not only Boeing, but suppliers are starting to furlough, and it's going to cascade through the entire supply chain.
How do you think the credit rating agencies are viewing this?
The credit ratings, let's talk about the earnings call outside of the strike for a second, too, because I think that's the most significant thing we learned yesterday is Boeing essentially added another $4 billion loss outside the strike to 2024 financials. So if we move from losing $10 billion, which is a significant number, to $14 billion in 24. But what we also learned was that 25 will be a loss. And that was, I think, surprising to the market. But the fact that the stock was only down 1.5% tells you some of it is embedded in. So I don't know how the rating agencies are going to stomach the free cash flow loss in 25. They needed free cash flow positive to keep the investment grade rating.
Are you satisfied we've had the kitchen sink moment? That this is all the bad news that we can take and ultimately this stock can start to perform well?
I think the next 3 quarters of free cash flow losses in the $4 billion range is pretty satisfactory.
So the White House has gotten involved in this one. You had Julie Su, the acting labor secretary, going over there. She's been in the middle of the negotiations. So they need to do more. Do you think this is embarrassing at all for the White House? This is one negotiation they were part of that they weren't able to get over the finish line.
They just started becoming a part of that discussion about a week ago. I don't know how closely they've been involved, but clearly this strike is now day 42. The last strike was 58 days in 2008. We don't want to repeat that, given how much everyone needs Boeing aircraft. Whether we like it or not, this is a global duopoly, and Boeing is essentially producing 0 MAXs at the moment.
I'm not sure what the role of the White House is in this one. If I look at the port strikes, I can see some clear and obvious leverage that they had going into the election. And I can see why the White House would be heavily involved, putting pressure on them to basically end the strike, because they're worried about how it would influence the election. And I have to be honest with you, I'm not sure how many people are voting over the next 2 weeks who care less about the Boeing strikes. Is that even on the radar of many voters?
Well, I think the West Wing cares about it in the sense that Boeing is part of the U.S. industrial base. This is so important to the U.S. defense sector.
Yeah, I guess in the next 2 weeks, according to Delta, nobody's going to travel on Election Day anyway, so prices aren't going to go up, so it's not material. But, I agree, it's not going to impact, the holiday season with the port strike. But I do think at some point it's going to push up prices, which is positive for the airlines.
Just before you go, we got some numbers from Southwest. So EPS came in at 15 cents. The estimate was just a little more than 7. Looking at operating revenue of 6.87 billion, the estimate of 6.81. As you gauge the numbers as they come in, Southwest, you're just hearing them, I understand, for the first time, and American a little bit later. What are you looking for from the industry as a whole this quarter?
Southwest, we're looking for them to kind of solidify. They pre-announced, so we knew they were going to be mildly positive, with Elliott knocking on their door, asking for a management overhaul, a board overhaul. So let's see if they give any additional quantification is what we're looking for on their investor day targets. They're looking for $6 billion of EBIT in 2026, Street's at $2 billion. So any color around that would be really helpful. American, we're looking for a potential credit card deal after they've really had issues in their corporate strategy.
Have they fixed things now?
No.
Still haven't fixed things?
No, it's resulted in about 200 million of headwinds per quarter on the corporate side. But let's see if they have a credit card deal negotiated. That would be the positive we're looking for.
Interesting. Sheila, it's good to see you.
Thank you.
Thanks for catching up with us. Sheila Kahyaoglu there of Jefferies with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Some more earnings to get through this morning. UPS up nearly 7% in the pre-market. A return to sales and profit growth for the first time in nearly 2 years. Higher volumes, more profitable packages, steadier labor costs, all of that contributed to the beat. The parcel industry has been under pressure from weak shipping demand off of the COVID peaks. But in this quarter, UPS's largest business, U.S. domestic packages, climbed nearly 6% to beat estimates. UPS stock was down 16% so far this year. IBM, those shares are falling in the pre-market trade. The company reported disappointing sales for the third quarter, hurt by slowing consulting demand. Revenue rose 1% in the period, and that just missed analyst estimates. IBM CFO says that clients aren't expanding budgets, and some generative AI projects are coming at the expense of traditional consulting. Those shares down 5%. Keurig Dr. Pepper is buying energy drink maker Ghost for over $1 billion. The Wall Street Journal reporting that Keurig would pay $990 million in cash in exchange for 60% stake in Ghost and eventually acquire the remaining stake by 2028. Buying Ghost would mark Keurig's biggest acquisition since it bought Dr. Pepper Snapple in 2018. The move comes amid consumers not debating over whether Starbucks is any good, but instead just drinking energy drinks instead of coffee on the way to work and the gym. And that's your brief, John.
Let's not start that again, Danny. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the threat of a global trade war.
If you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
More from Lisa down in Washington, D.C. from the IMF annual meetings. Up next.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China, all of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Just turned yesterday upside down. That's what this market looks like. Up 0.4% on the S&P, yields a little bit lower, down 5 or 6 basis points. The 10-year, a break of 420, 418.99. Under surveillance this morning, the threat of a global trade war.
We find that an escalation in trade wars, regardless of where they're coming from, this is not just the U.S., by the way, there's been a lot of increase in trade policy, distorting measures by a number of countries in the last few years. If you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
So here's the latest. The IMF warning that increasing protectionist policies are a downside risk to growth as the outcome of the U.S. election looms large over the annual meetings in Washington, D.C. Lisa is back with us from the IMF in Washington with South Africa Central Bank Governor Lesetja Kganyago. Hey, Lisa.
Hey, John, thank you so much. And yes, I am here with Lesetja Kganyago, the head of the South African Central Bank. And it's not all about the election with respect to trade wars, but also the ramifications for inflation at a time where you're considering actually lowering your inflation target. Can you talk about how you understand the appropriate inflation target at a time where you're looking at something like 4%, you're currently at 4.5%, while the rest of the U.S. and Europe looked at 2%?
Well, what is no doubt is that South Africa's inflation target is out of sync with peers. Developed economies, yes, are focused on a 2% target, but the rest of the emerging market universe are looking more closer to 3% than to 2%. And if you look at a country like Australia, it's not quite 2%. They give themselves a margin around the 2%. I think that what we are clear is that we put our inflation target in 2000. It is now 24 years since we had the inflation target, and we had to ask questions about how optimal the current inflation target is, and it is the work that we are doing with the Treasury to them. What is clear is that if we revise the target can only be revised lower.
Do you think that in some way the emerging world and the developed one are converging, that in some ways you might lower your inflation target to 3%, and maybe it might be appropriate for a number of developed market economies to raise their inflation rate to closer to 3%? The you see a regime like that?
Well, it has not been our baseline. I think that the emerging markets have come closer and closer to the developed market targets. I think what's clear is that there's no virtue in high inflation, and the lesson from the great inflation surge in 2022 had been that the public actually hates inflation, and actually the public will prefer price stability.
But what's the cost of having a lower inflation target? And this is something that the Federal Reserve is grappling with. At the same time that they're talking about the dual mandate, they don't want people to lose their jobs in some sort of entrenched fashion, even if it means the consequence of having higher inflation. Do you think it's worth having a little bit more pain economically in order to bring inflation back into a closer to 3% range?
Well, the problem with that analysis, Lisa, is an assumption that there is no cost to the economy of having higher inflation. There is a cost. And we have seen it with the public rising against the high cost of living, and it is important that one is alive to that. That said, many central banks will then grapple with what we call the sacrifice ratio. How much growth do we have to give up in order for us to bring down inflation? What is clear is that once you have brought down inflation and the inflation rate is almost taken out of the decision-making matrix of the decision makers, price setters, then and investors, then you know that you have brought in price stability.
Are you basically saying that maybe the ECB has it more right with respect to being a single mandate central bank rather than focusing on a dual mandate of employment and inflation?
You know, what the policy anchor for a central bank is a political choice by the elected representatives of a particular country, and I think that the Fed has a dual mandate. The ECB doesn't, neither do we. But what is understood in our constitution is that having a low and stable inflation is done in the interest of balanced and sustainable growth.
Lesetja Kanyako, always wonderful to see you. Thank you so much for being with us today. That's Lesetja Kanyako, the head of the South African Central Bank. John,
Hey, Lisa, that was great. Fantastic as always. Look out for more from Lisa a little bit later. She'll be speaking with Amin Salam, the Lebanon Economy and Trade Minister, and Wakim Nagel, the Bundesbank President. Do not miss that, 8:45 Eastern Time. Lesetja Kanyako said it, Governor Kanyako, people hate inflation, and don't they just?
Yep, and if we revise inflation target, it must go lower. This is the issue that's not just happening in South Africa, it's happening in the United States. This is what continues to show up in the polls. It's happening around the world. Inflation, it bites people's issue to go out there and their purchasing power.
Still a massive issue on the campaign trail. Up next, big hour on this program. We'll catch up with Brian Nick of New Edge Wealth, advisor to President Biden, Dilip Singh, Dana Peterson of the Conference Board, and former House Speaker Kevin McCarthy. All of that in the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech.
Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment managers' views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And so when we Queen or we own whatever it may be. We look at that as a business, and when we own Coca-Cola or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. I mean, all of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors. There's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business, and we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have, and it's changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, "You've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use." And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math, or you learn a little
more. Jobless claims are going to be interesting because the distortion you said, and then of course the payrolls report. We already have noisy data when it comes to the jobs data. People already take off 60, 70K because of revisions. How much harder is that going to be to read based on what we had in terms of hurricane impacts and impacts of things like Boeing, which did not get their deal?
You know better than most where the polls are, where they've been and how they've trended over the last month or so. This is what is of interest to me. If I speak to market participants, a lot of them would say that this market has started to lean in towards the prospect of a Trump 2.0 presidency. That's where the momentum is. And then if I ask you where the polls are, I don't hear much change at all over the last few weeks.
Very little change. And depending on which poll you look at, either candidate might be leading. In ours, it is pretty much this latest poll we've done. We've been doing them for 12 months when Biden was still at the top of the ticket. It is a dead heat. One thing is consistent across a lot of pollings I've been reading, and that is the economy is still the #1 issue for this electorate, and the trust factor. Who has the trust of the American people when it comes to things like handling the economy? That remains in Donald Trump's hands. That's the one issue. But if you look at these polls, it's a knife's edge.
That's the politics. Here's the earnings. Check out American Airlines in the pre-market. That stock is higher by 2.2%. Here's some of the headlines for you. EPS coming in at 30 cents, an estimate of 14. Passenger revenue, 12.52 billion, the estimate 12.37. That's an upside surprise and another upside surprise. And here's another one. This is how they see full-year adjusted EPS, 135 to 160. They had seen 70 cents to 130. So that stock is up by about 3%. That's a beat and a raise. Coming up this hour, we'll catch up with Brian Nick of New Edge as Tesla earnings boost equity markets. Advisor to President Biden, the leap Singh, as the G7 finalizes a loan to Ukraine using Russian assets. And former House Speaker Kevin McCarthy on the most critical swing state to watch on election night. We begin this hour with stocks bouncing back as Tesla earnings kick off the Magnificent Seven with a blowout quarter. But Brian Nick of New Edge remaining cautious, saying we see Mag 7 earnings decelerating next year to a still healthy rate around the mid-teens. But we are concerned about lofty expectations for everyone else, especially absent an economic reignition triggered by falling rates. Brian joins us now for more. Brian, good morning.
Morning.
Let's start the bond market. Sure. Then we'll work our way to equities.
Sounds good.
Dissect the sell-off of the last few days. What's behind it for you?
We really hate to attribute any market moves to things that are happening in politics with the election, but if you kind of map the 10-year, and you've probably all seen this graph on top of the betting odds in a number of different markets for Trump, they're moving basically in sync right now. So there is a sense, I think, that the markets are increasingly worried about some kind of fiscal risk. It's hard to pin down to determine exactly what the concern is, but some kind of fiscal risk that is causing the yield curve to steepen, especially long-term rates to move up. And at the same time, you're not seeing sort of a full-throated endorsement from the Fed speakers we've seen, that interest rates are going to continue to come down. They've gotten, if anything, a bit iffier in their outlook since they cut by 50. I think the combination of those two things with some of the strong data we've seen last month's payroll report and the retail sales number, not uniformly strong if you're looking at the rest of the data, but in general enough to support rates at least where they are.
I was going to come back and say, if you map the 10-year row for the economic surprise index, would you see the same thing?
Economic surprise index has improved. It's not like it's gangbusters, but it's kind of gone back to neutral. The economic data has been sort of surprising, not really one way or the other on net. But the movement has been towards, a more positive surprise. So there's maybe overdetermined explanation for why the 10-year has been moving up. I think that next week's report is going to be very, very hard to sort of pin down in terms of what it's saying because of all the distortions. And that's just going to make us basically set us up for another month where we're just waiting for this very small number of data points that still seem to matter.
So we've got the earnings. Yep. And I think the same applies to the financials, and we've talked about it around this table. Bank earnings have been pretty good. Some people have sat here, though, and said that this is about a Trump trade. This is about looser regulation, the prospect of high yields and rates remaining at this level for the time being into 25. Would you say it's more about the earnings?
Yeah, we're pretty comfortable with financials right now. If there's one sector that we're kind of looking at, maybe moving more into, that would be the one. What we're concerned about, I think, is the economically sensitive names, sort of in industrials, anything related to housing. We've seen those start to pull back. The concern there is that we're not going to see that interest rate dip, what we've been talking about with the election or the better data, that a lot of these analysts have been counting on lower interest rates to support these companies' earnings next year. And you see a really broad-based earnings acceleration across large and small cap stocks next year in sort of the analyst estimates. And if we don't get the interest rate dip and we don't get the reignition, those expectations look much, much too high to us right now. So we're pretty cautious overall on cyclicals. Banks might be the exception.
When it comes to equities and the relationship to politics right now, and this idea of a Trump trade, John mentioned deregulation, but also this idea that you can have a 15% corporate tax rate. The issue is that comes with all these provisions attached to it. You have to be made in the United States. Why are people not concerned about this idea of tariffs going up and that their inputs to make something in the United States might be so much more expensive?
This is where it gets really hairy to try to divine anything from the politics to try to explain what's going on with markets, because it seems like investors may be taking a leap, A, that they know the outcome, B, that they know what the policy will be based on the outcome, and then C, that they know what the market reaction will be to the policy. That's a lot of leaps to be taking. Going back to the first Trump term, the 2016 election, which was a surprise outcome, you're seeing a lot of the same patterns in markets. That's one of the reasons we kind of attribute what we're seeing, the stronger dollar, higher 10-year yield, better performance among cyclicals, sort of stop-start. All that happened after the 2016 election. But those trades all reversed within a couple of weeks, if not months. By the end of 2019, again, before the pandemic hit, interest rates were lower. Cyclicals had not been outperforming, and that was even with a huge deficit expanding tax cut and with tariffs. So I'm not sure why the conclusion is that certainty of tariffs next year should necessarily make you think the 10-year yield should be higher. If anything, I would say it should be lower.
You also talked about the fact that the bond market is basically following the betting markets. Why the betting markets when we've seen this in the past? There was a Romney whale in the betting market. He never made it to the White House. Why are they not following the polls, which are neck and neck?
Sure, and as those Bloomberg polls yesterday were state by state, everything's within like 1 point. So it's very hard to look at that and say, we think we know what the outcome's gonna be. And that's why we're not getting ahead of the election with any kind of trades that we think are gonna be contingent on the outcome. I would say that I think the betting market's probably reflecting the idea that in the last 2 presidential elections, the polls have understated the support for Trump at the end of the day, and maybe there's a speculation that you can just add 3 or 4 points to whatever he's getting in the polls, and that might be why we're seeing that. Also doing a little bit better in the national polls, which doesn't count for the popular vote, but seeing that move up and that narrow in the last couple of days. But again, I think it's going to come down to what the payrolls reports do over the next 6 months. And we're not optimistic that we're going to see a reacceleration in job creation. We're not optimistic that the tick down in unemployment is going to last. We could be at 4.5% unemployment by March, in which case I think the 10-year yield is going to be a lot lower.
So November 7th, we don't have an outcome of the U.S. presidential election, potentially. What does the Fed do?
We're going to have an outcome from the FOMC meeting at least, right?